Hello champions, in this session we are going to do a nice solid concept revision of FEMA, Foreign Exchange Management Act 1999. Happily, without any tension, without any worry, slowly let's take up the concept one by one and let's nicely revise. Our very first discussion over here is about the salient features of FEMA. First of all, understand the meaning of this term salient features. What is this list, guys? In this list I'm having some 8 to 10 points. What is this list? Basically, this list is like an index of what are all the topics on which FEMA has rules and regulations. It's like giving you a bird's eye view of the whole of FEMA, that FEMA contains provisions, rules and regulations relating to what? Let's see them one by one. The hint to remember is rice, and then 3 A's, and then I. Now, what does R stand for? R stands for regulation. Regulation of what? Regulation of transactions. Transactions between whom? Transactions between residents and non-residents. So, R stands for regulation. Regulation of what? Transactions. Transactions between whom? Residents and non-residents. Simple, guys. Then we have two I's, guys. Basically, we are talking about two investments over here. Number one, investments in India by non-residents. Now, ulta. Investments outside India by Indian residents. So, two I's, simple. To I for investment. First I, investment in India by non-residents, and second I, investments outside India by Indian residents. Then we have two C's over here, both talking about two types of transactions. So FEMA regulates both current account transactions also and capital account transactions also. And then lastly, FEMA also contains rules and regulations relating to E for export proceeds. Now this is interesting, okay. Here I have two keywords. My first keyword over here is realization of export proceeds. My second keyword is repatriation of export proceeds. Let me help you understand. You know very well that we keep encouraging exports. We keep saying export. But then see, if I export, but if I don't bring the money back into India, was the export even fruitful? No. So that is why FEMA makes rules and regulations for realization and repatriation of export proceeds, which means there are two words. Let's talk about the two words one by one. The first word over here is realization. Realization means what? Realization means, let's say I am in India and you are in the US, guys, and let's say I have sold goods to you. Now after selling the goods to you, you have to give me the money, right? So realization means I have to recover the export proceeds from you. Now after recovering the export proceeds from you, I can't let the money be in US. I have to bring it back into India. I have to repatriate it to India. Understanding? There are two steps. First, I realize the money. Realize the money means first I recover the money from the foreign buyer, and then I repatriate to India. I bring it back into India. So FEMA contains rules and regulations for this also. So you're understanding what this whole list is, right? This list is like the salient features, the most striking features, the most important contents of FEMA. That what are all the provisions that FEMA talks about. So the first 4 points are clear. R stands for regulation. Regulation of what? Regulation of transactions. Regulation of transactions between whom? Regulation of transactions between residents and non-residents. Then I. We have two I's over here. Investments in India by non-residents and investment outside India by Indian residents. Then we have two C's. Current account transactions and capital account transactions, and then E stands for export proceeds. Till here, okay. Now see, this might look like not a very important topic. This might look like only salient features, not very important, only characteristics, but extremely important, guys. Straightforward theory question you can get from here. In FEMA, I cannot say this is important, this is not important. Every single topic we discuss over here is important, so you will skip nothing, okay. Now listen, coming to the next part, the remaining 4 points, we have 3 A's and an I. Now, what does the first A stand for? The first A over here stands for dealing in foreign exchange through authorized persons. So basically, FEMA gives rules and regulations that if you want to buy foreign exchange, you will buy through whom? If you want to sell foreign exchange, you will sell through whom? If you want to transfer money, you will transfer money through whom? They are your authorized persons. So dealing in foreign exchange through authorized persons. Then we have another A for adjudication of offences and compounding of offences. There are two things over here, adjudication and compounding. Understand, the whole objective of FEMA is to regulate. The whole objective of FEMA is not to harass. The objective is to regulate. So, okay, adjudication of offense means if something has gone wrong, if there's a non-compliance, how will we investigate and find out the non-compliance and how will we punish? That is adjudication, guys. Compounding of offense means now there's an offense, now we have to punish. So instead of punishing, let us settle it. Let us settle the matter. That is going to be compounding of offenses. So FEMA gives provisions for both how to adjudicate the offense, which means how to decide how much punishment to give for the offense, and also how to compound the offense, how to settle the matter. Then another A, appeal. Appeal provisions including special director appeals and appellate tribunal. Like for example, let's say the Directorate of Enforcement. I'll be talking to you about the Directorate of Enforcement in the next point only, whom we often call as the ED. the Directorate of Enforcement, let's say, has passed an order against you and you're unhappy with the order. You want to file an appeal. So, yes, FEMA does give provisions for filing appeal also. You can file an appeal before Special Director Appeals and Appellate Tribunal. And then lastly, A stands for, lastly, I stands for investigation. Investigation of offences by the Directorate of Enforcement. The Directorate of Enforcement, very often called as a ED. Now, what does he do? Who is he? Understand, he is like the policeman, okay? Now, he is the one who's going to find violations, and if there's a violation, he is the one who's going to start investigating about the violation. He is the one who's going to give the punishment. So he's like for example, if somebody illegally sends money outside India, or if somebody illegally receives foreign currency in India, his whole job is to catch violations like these, catch the violation and then punish. So that is the role of the enforcement directorate. Look at him like one policeman. Okay, so now these are your salient features, guys. I've taught them to you in the form of 8 points. So R for regulation. Regulation of what? Transactions. Which transactions? Transactions between resident and non-resident. Then I stands for investment. 2 investments. Investment outside India by Indian residents and investment in India by non-residents. Then 2 C's, guys. C for capital account transaction. C for current account transaction. And then E. E stands for export proceeds. Export proceeds have to be first realized and then they have to be repatriated to India. So FEMA gives us rules and regulations relating to all of these. So these were your first 4 points. Rise. Now 3 A's and 1 I. So A stands for authorized persons, dealing in foreign exchange through authorized persons. So FEMA gives us rules and regulations that who can be authorized persons, what returns they have to follow, what information they have to collect, all provisions relating to that. Then A stands for adjudication and compounding of offences. Another A stands for filing appeal, and then I stands for investigation. Investigation by whom? Investigation by the Directorate of Enforcement. Okay, so simple, guys. These are the 8 salient features of FEMA. How will you remember? Rise, and then 3 A's and I. Okay, so tell me, what does R stand for? Regulation. I for investment. C for current account, capital account. E for export proceeds. Then we have 3 A's. The first A is for authorized person, another A is for adjudication, another A is for appeal, and lastly I is for investigation. Investigation by whom? Investigation by the Enforcement Directorate or Directorate of Enforcement. Okay, now FEMA is enforced by whom? The enforcement of FEMA is by Directorate of Enforcement. I've already told you what he does. He will act like a policeman. He will catch violations, anybody wrongfully sending money outside India, anybody bringing foreign currency into India without following rules. So he will catch violations like this and investigate and punish them. And the overall control of FEMA is in the hands of RBI. So 2 people who is enforcing FEMA, the ED, Directorate of Enforcement, and who is having overall control over FEMA, RBI. Simple, guys. Now see, to manage foreign exchange in our country, what are the legal resources that we have? Number 1, we have the FEMA, Foreign Exchange Management Act. Then there are rules notified by the Ministry of Finance. Then we have regulations notified by RBI. We have notifications and circulars. We have master directions and FAQs. So all of these are legal resources through which we manage foreign exchange in our country. Through FEMA, Foreign Exchange Management Act, rules given by the Ministry of Finance, regulations given by RBI, notifications and circulars, master directions and FAQs. Okay, now come, guys, to the second main concept now. The first main concept was the salient features of FEMA. Now coming to the second most important concept in this chapter, where we're going to be learning about 3 things over here: the preamble, the extent and application and commencement of FEMA. So 3 things we will be learning. Number 1, preamble, then extent and application together we will be learning, and finally commencement of FEMA. Let's talk about the preamble first. Preamble is nothing but an introduction to the law, guys. So preamble gives you a very brief summary of what exactly the law is all about. Read the preamble with me first. The preamble says that this act aims to consolidate and amend the law relating to foreign exchange with the objective of facilitating external trade and payments and promoting orderly development and management of foreign exchange market in India. Slowly, one by one. So what does the Foreign Exchange Management Act do? What is its aim? Its aim is to consolidate. Consolidate means what? Put in one place. So through FEMA, we have in one place all the rules and regulations relating to foreign exchange. So it is consolidating and amending. Why do we have the word amending? Because before FEMA, we had Foreign Exchange Regulation Act. So therefore, through FEMA, we are amending the existing provisions and we are creating a new law altogether. So we are consolidating and amending the law relating to foreign exchange with the objective of facilitating external trade. External trade is nothing but imports and exports, guys. So we're facilitating external trade and payments and orderly development and maintenance of foreign exchange market in India. Learn it with me. Come on, guys. This part I'm going to make you learn it with me right now, right here. Repeat along with me. Number 1, what does this act do? it consolidates and amends C and A. It consolidates and amends what? The law relating to foreign exchange. Once again, what does this act do? It consolidates and amends the law relating to foreign exchange. Once again, what does this act do? It consolidates and amends the law relating to foreign exchange. Then, what is the whole objective of this law? What does this law want to do? What is the objective of this law? Two objectives, guys. Objective number one, it wants to facilitate external trade and payments. This is very simple. It wants to facilitate imports and exports. It wants to facilitate external trade and payments. Now, coming to the second point, it wants to promote orderly D&M of FM. It wants to promote orderly development and maintenance of foreign exchange management. See, why am I giving you all these points over here? Because no matter how nicely you understand this, in the examination for the preamble, if they ask a question, they will not give you marks until and unless you have written this part word to word. So therefore, to help you learn this word to word only, I've given you these points, because understanding is very simple, guys, over here. The whole challenge over here is remembering this as it is, right, guys? So come on, guys, one last time, tell me the whole preamble word to word, because that is how we will write in the examination also, and we will surprise the examiner. So what does the preamble say? This act aims to consolidate and amend the law relating to foreign exchange with the objective of two objectives, guys. First objective is to facilitate external trade and payments, and the second objective is to promote orderly D&M, development and maintenance of FM, foreign exchange market in India. Okay, so this is a preamble. Now come to the second part. The second question is extent and application of the of our act. So the Foreign Exchange Management Act extends to the whole of India. But however, the most unique point about FEMA is that it not only applies to India, it also has extraterritorial jurisdiction. Extraterritorial jurisdiction means it not only applies to India, but there are two situations where it also applies outside India, guys. Like for example, it will also apply to BOA, that is branches, offices and agencies outside India which are owned or controlled by PRI, persons resident in India. So it will also apply to BOA which is outside India, provided it is owned or controlled by a person resident in India. Similarly, it will also apply to contraventions. Contraventions are nothing but violations of the law. It will also apply to contraventions outside India by a person to whom this act applies. So if there's a person to whom FEMA is applicable, if this person is going out of India and violating this law, for that violation also FEMA will apply. So you can't say I violated the law in Russia, so don't punish me under Indian Act. You can't say that. If you are a person to whom FEMA applies, even if you go to Russia and if you do a violation over there, even on that violation we will apply FEMA. So guys, come on, the extent and application of FEMA, it extends to the whole of India. But not only in India, it also has extraterritorial jurisdiction, which means it also applies to BOA outside India which are owned or controlled by PRI. It will also apply to contraventions outside India by a person to whom FEMA is applicable. Okay, this was a second question, extent and application. Then comes the third question, commencement of FEMA. When did FEMA commence? When did it start applying? The act came into force with effect from 1st June 2000. Remember this? All of these are your potential MCQ questions. So coming back to the discussion now, there were three things we saw over here: preamble, extent, application and commencement. So with this, we're done with the first two concepts, guys. Now after this, we have a lot of definitions. But before we go to the definitions, can we do one final revision of everything we've learned till here? So first of all, we learned about the salient features of FEMA. There were 8 salient features of FEMA. Come on, tell me without seeing. R was for regulation of transactions between residents and non-residents. Then I, 2 I's we had investment outside India by residents and investments in India by non-residents. Then 2 C's we have current account transactions, capital account transactions. E was for export proceeds, realization and repatriation to India. Then we had 3 A's, guys. The first A was dealing in foreign exchange through authorized persons. Another A was adjudication and compounding of offences. Another A was appeals. And lastly I was for investigation of offences by ED, Enforcement Directorate. Okay. Then after this, our second big learning was preamble, extent, application and commencement. Tell me the preamble as much as possible. Tell me without seeing. This act aims to consolidate and amend the law relating to foreign exchange with the objective of two objectives, guys. First objective is to facilitate external trade and payments. Second objective is to promote orderly D&M, development and maintenance of FM, foreign exchange market in India. Okay, that was a preamble. Then extent and application. The extent and application says that FEMA extends to the whole of India. But not only India, it also has extraterritorial jurisdiction. It also applies to BOA outside India, owned or controlled by PRI. It also applies to contraventions outside India by a person to whom FEMA is applicable. And finally, we learned when did this act come into force? It came into force on the 1st of June 2000. Okay, guys. So with this, you're nice and thorough with my first part of the discussion. Now, come on, let's enter into the definitions. My first definition over here is definition of authorized person. So authorized person or AP means, we have the word means over here, so it's an exhaustive definition. Means AMOA. A for authorized dealers, M for money changers, O for offshore banking units, and A for any other person authorized to deal in foreign exchange or foreign securities. Once again, who is an authorized person? We have the word means over here. So means indicates this is an exhaustive definition. It means 4 people: AMOA, A for authorized dealer, M for money changer, O for offshore banking unit, and A for any other person who is authorized to deal in foreign exchange and foreign securities. This is about authorized person. Then we have export. Export means what? Here also we have the word means. This indicates again it's an exhaustive definition. It means taking out of India. Export means what? From export means I have an Indian seller and a foreign buyer, right guys? So which means I'm taking out of India. I'm taking out of India to a place outside India any goods, or providing services from India to any person outside India. So in export, I am taking goods from India to outside India, or I am providing services from India to outside India. That is export. Then comes your meaning of import. What does import means? Again we have the word means indicating it's again an exhaustive definition. Import means bringing the goods and services to India, bringing into India any goods or services. So 3 definitions guys: authorized persons, export, import. Export, import were simple, you all know about it. Authorized person is what I'm more bothered about. Authorized person means AMOA, A for authorized dealers, M for money changers, O for offshore banking units, and A for any other person who is authorized to deal in foreign exchange and foreign securities. Then export means taking out of India to a place outside India any goods, or providing services from India to any person outside India. What is import? Import means bringing into India any goods or services. Okay, now come to currency. Now this is an important definition once again. Currency includes. So here we have an extensive definition. Until now, if you see the definitions that we have seen until now, authorized person was also an exhaustive definition, export was also an exhaustive definition, import was also an exhaustive definition. Now we have currency. This is an extensive definition. We have the word includes over here. It includes what? It includes CP, MTLB. This is going to be your hint guys. It includes CP, and MTLB. So let's see them one by one. So C stands for currency notes, P for postal notes, C for checks and drafts, P for postal orders, C for credit cards, P for promissory notes. This is CP. Then MTLB. M for money orders, T for traveler's check, L for letters of credit, and B for bills of exchange. Try telling me without seeing now. C for currency notes, P for postal notes, C for checks and drafts, P for postal orders, then C for credit cards, P for promissory notes, then MTLB, M for money orders, T for traveler's check, L for letters of credit, and B for bills of exchange. So right now I'm not focusing on going in depth inside each of these boxes, not required, because right now what we're trying to do is an exam oriented pure revision. So come on everybody, once again try to tell me without seeing. Try as much as possible. Try. Let's see where you're getting stuck. C stands for currency notes, P for postal notes, C stands for checks and drafts, then P stands for postal orders, then another C for credit cards, another P for promissory notes, then M for money orders, T for traveler's check, L for letters of credit, and B for bills of exchange. Okay, now this was the meaning of currency. Currency includes all of these things. Now this currency can be of 2 types guys. Currency can either be Indian currency or currency can be foreign currency. Okay, so Indian currency or foreign currency. Indian currency means INR. Any currency other than INR will become foreign currency. Alright. So this was the definition of currency. So 4 definitions we have seen: authorized persons, export, import, and currency. And also don't forget guys, currency includes both Indian currency and foreign currency. Indian currency is nothing but INR, and all currencies other than Indian currencies are foreign currency. Okay, now come on. We're going to do 2 extremely important definitions now. First we will learn about foreign exchange, and then we will learn about foreign security. Both, each of them more important than the other. Okay, come on, let's talk about foreign exchange first. Now foreign exchange definition also, foreign security definition also. Both the definitions, if you see, will have 2 parts. What does it mean and what does it include? Okay, so let's focus on foreign exchange first. Now the foreign exchange definition has 2 parts. What does foreign exchange mean and what does foreign exchange include? Foreign exchange means foreign currency. And what is foreign currency? We know very well guys, any currency other than Indian currency. So what does foreign exchange mean? Foreign exchange is nothing but foreign currency, like dollars, euros, yen, and all of these. But however, the special point is that foreign exchange is not just dollars and euros. Foreign exchange also includes special types of transactions and special types of instruments. Even they come under foreign exchange, and that is what is mentioned in the second part. So what does foreign exchange mean? Foreign currency. But foreign exchange also includes, number 1, deposits, credits, and balances. Deposits, credits, and balances payable in foreign currency. Like for example, deposits. Like let's say I have $1,000 in a foreign bank account. Let's say I have an FD in dollars. So it's a deposit. It is a deposit. It's money in foreign currency. My best example for you is my first example. I have $1,000 in a foreign bank account. That is also going to be foreign exchange. Then credits and balances payable in foreign currency, which means like for example, let's say I have a receivable or I have a payable in foreign currency. Even that will come inside foreign exchange. So foreign exchange includes deposits, credits, and balances payable in foreign currency. Repeat again, foreign exchange includes deposits, credits, and balances payable in foreign currency. Then number 2, it also includes DTLB. See, TLB you know very well. In our currency definition, we have MTLB. So the same TLB I'm taking from there and I'm adding a D. Okay. D for draft, T for traveler's checks, L for letters of credit, and B for bills of exchange. So TLB are the same, only D I'm adding extra. These instruments, so I'm talking about some specified instruments. These instruments which are drawn or expressed in Indian currency. So they are drawn in INR, but they are payable in foreign currency. They are drawn in INR, but payable in foreign currency. Foreign exchange will include these also. Then foreign exchange will also include the same DTLB which are drawn outside India. So drawn in dollars, but payable in Indian currency. So they may be drawn in INR, but payable in dollars, or they may be drawn in dollars, payable in INR. Even that will come under the foreign exchange umbrella. Understanding, guys? Come on, let's revise. So the definition of foreign exchange, how many parts in the definition? We have 2 parts in the definition. What does foreign exchange mean, guys? Foreign exchange means foreign currency, but it is not only foreign currency. It also includes specific types of transactions and specific types of instruments. Like it also includes deposits, it also includes credits and balances which are payable in foreign currency. Then it also includes all those drafts, travelers checks, letters of credits, and bills of exchange which are drawn in INR but are payable in foreign currency. Then it also includes all those drafts, travelers check, letters of credit, and bills of exchange which are drawn outside India, so drawn in dollars, let's say, but payable in INR. Got it, guys? This was a definition of foreign exchange. Very simple definition once you understand it. So come on, guys, let's try saying the definition once again, but this time as much as possible without seeing. I have kept the whole definition in front of your screen, but you will look at the definition only when you forget. But first try to put pressure on your memory. Let's try to learn it now itself. So foreign exchange means includes 2 parts. So means foreign exchange means foreign currency. Foreign currency is nothing but any currency other than Indian currency. Simple. In foreign exchange includes 3 things. Thing number 1, deposits, credits, and balances payable in foreign currency. Then number 2, DTLB, guys, drafts, traveler's check, letters of credit, and bills of exchange drawn or expressed in Indian currency but payable in foreign currency. Then number 3, same, drafts, traveler's check, letters of credit, and bills of exchange which are drawn outside India but payable in Indian currency. Okay, so these are your 3 things that will come under the second part. It includes deposits, credits, and balances payable in foreign currency, DTLB drawn in Indian currency but payable in foreign currency, and the same DTLB drawn outside India but payable in Indian currency. Right, guys? Now come to the second important definition, foreign security. Even this is important. Foreign security, even over here we have the first part of the definition which says what is foreign security means, and then we have the second part of the definition which says what is foreign security includes. So foreign security means any security in any form, guys. It can be shares, stock, bonds, debentures, or any instrument, just that it should be denominated or expressed in foreign currency. Like for example, Apple stock, Apple shares are denominated in dollars. Tesla shares, they're denominated in dollars, so they will become foreign securities. So foreign securities means securities in the form of shares, stock, debentures, bonds, or any instrument, just that it should be denominated or expressed in foreign currency. But however, foreign security also includes those securities which are expressed in foreign currency, but however, the redemption or the return will be in Indian currency. Like for example, guys, let's say there's a company. This company has issued bonds, okay, where the company is saying that one bond is for $100. So therefore, the bonds are expressed in foreign currency. But however, company is saying, don't worry, for these bonds, whenever we pay interest, the interest we will pay in INR. Later, when we redeem these bonds, the redemption amount when we give, even that we will pay in INR. So even though there is some element of INR over here, because the bonds are expressed in foreign currency, because of that reason, even they will become foreign security. Understanding? So foreign security means securities in the form of shares, stock, bonds, debentures, or any other instrument, guys, just that it should be denominated or expressed in foreign currency. It also includes those securities which are expressed in foreign currency but redemption or return or both are payable in Indian currency. So even though interest is paid in INR, even though redemption amount is in INR, but because they are expressed in foreign currency, because they are expressed in dollars, because of that reason these bonds in my example will become foreign security. So what is important is what is the currency in which they are expressed, what is the currency in which they are denominated. They should be denominated or expressed in foreign currency, and that is how those securities will become foreign securities. Whether the interest or the dividend or the redemption value is paid in INR or paid in dollars, it will not make a difference. Whether the redemption value is in dollars, whether the redemption value is in INR, whether the dividend is paid in dollars, whether the dividend paid is paid in INR, doesn't matter. What matters, what is more important is that they must be expressed, they must be denominated in dollars. Understanding? So two extremely important concepts we've discussed now. First was foreign exchange and the other was foreign security. Okay. So until now, if you see the first part of our discussion, we spoke about the salient features of FEMA, rise, 3 A's and an I. Then we spoke about preamble, extent, application and commencement. And till here guys, multiple times I've already given you a revision. Then we spoke about 4 small definitions, and even here, till here we've revised 2-3 times already. Now come on guys, even though foreign exchange and foreign security, even though we've learned it properly, can we do one final revision so that confidently we can close till here and we move on to the second set of discussions? Listen now. One final discussion, one final revision on Forex and Forse. What does foreign exchange mean? It means foreign currency, and foreign currency is nothing but any currency other than Indian currency. And it includes how many things? It includes 3 things. Number 1, it includes deposits. It includes deposits, balances, deposits, credits and balances which are payable in foreign currency guys. Then it also includes DTLB, drafts, travelers check, letters of credits and bills of exchange, which are drawn in INR but are payable in foreign currency. It also includes drafts, travelers check, letters and bills of exchange, which are drawn outside India, let's say in dollars, but are payable in INR. Right guys, this was our meaning of foreign exchange. It means foreign currency. It includes deposits, credits and balances which are payable in foreign currency. It includes drafts, travelers check, letters of credit and bills of exchange which are drawn in INR but payable in foreign currency, and also includes drafts, travelers check, letters of credit and bills of exchange which are drawn outside India in dollars but payable in INR. Okay, now listen guys, come to this part now. This is the thing that I wanted to do for you over here, this exercise. If you're able to answer this exercise properly, only then will we get the confidence that you've understood foreign exchange. Tell me first of all, will foreign exchange include dollars? Will dollars come under foreign exchange, yes or no? Yes guys, because foreign exchange means foreign currency. Any currency other than Indian currency, dollars is not Indian currency, so this will come under foreign exchange. Then will foreign exchange include INR also? No, because it will include only foreign currency, it will not include Indian currency. Then dollars in a foreign bank account, will this also come under foreign exchange? Yes guys, this was the example which I had given you for deposits. So deposits would be nothing but whatever dollars, let's say I have $1,000 in my savings account in US, that will be foreign exchange. So dollars in a foreign bank account, even that will come under foreign exchange. Then I have dollars receivable. If you have any foreign currency receivable or foreign currency payable, that will be credits and balances, even that will come under foreign exchange. Then there's a bill of exchange. This bill of exchange was drawn in INR but payable in dollars. Will this be foreign exchange? Yes. This is DTLB, drawn in INR but payable in dollars. Similarly, if I have a bill of exchange which is drawn in dollars but payable in INR, will this also be foreign exchange? Yes, it will be foreign exchange. Understanding guys? Now similarly come to foreign security. What does foreign security mean? It means securities like shares or stocks or bonds or debentures, just that they should be denominated or expressed in foreign currency guys. But it also includes all those securities which are denominated or expressed in foreign currency, but however, the return or the redemption or both, any permutation or combination guys, is in INR. Even this will come under foreign security. So foreign security means a security which is denominated or expressed in foreign currency. It also includes those securities which are denominated or expressed in foreign currency, but the return or redemption is going to be in INR. But I told you multiple times over and over again, what is more important is that they should be denominated or expressed in foreign currency. The returns and the redemption may be in INR, may be in dollars, doesn't matter. What is important is that they should be denominated or expressed in foreign currency. Now again, come back to my table. Let's see if we're able to correctly answer this one. Apple shares guys, they're denominated in dollars. Tesla shares, they're denominated in dollars. So securities which are denominated in foreign currency will come under foreign security. So yes, they are foreign security. But what about Reliance shares? Indian companies' shares, guys, are denominated in INR. They will not be foreign security. They are denominated in INR. They will not be foreign security. Then I have bonds. These bonds are denominated in dollars, but I get interest in INR. See, even though I get interest in INR, what is important is that they are denominated in dollars. So because they are denominated or expressed in dollars, they will be foreign security, guys. Similarly, I have shares which are denominated in dollars, but I'm getting dividend in INR. Even though I'm getting dividend in INR, what matters is that they're denominated in dollars. So because they're denominated in dollars, even this will be foreign security, guys. Then I have debentures which are denominated in dollars and they're going to be redeemed in INR. So even though they're going to be redeemed in INR, still what matters is that they're denominated in dollars. So if they're denominated in dollars, they will be foreign security, guys. So what matters is that they have to be denominated in dollars. The interest, dividend, redemption value may be in INR, doesn't matter. But however, my star adjustment over here, I have bonds denominated in INR, interest in dollars. Now, interest in dollars, guys. Redemption also in dollars, guys. Now, foreign security. No, not foreign security. Why? Because foreign security means the most important thing is that they must be denominated in foreign currency. But here, if you see, it is denominated in INR, guys. It is not denominated in foreign currency. It is denominated in INR only. So, which means my basic criteria itself is not being met over here. Doesn't matter the interest, the redemption amount, the dividend. That is in what currency doesn't matter. What matters is that they are denominated in what currency. They should be denominated in foreign currency, only then foreign security, but here it is denominated in INR, so that is why this will definitely not be foreign security. Understanding now? Perfect. 100% understanding. Yes, guys. So with this, I think I can confidently say that even Forex and Forse, you have nicely understood. Now come on everybody, let's move on to our next learning. We're going to be learning about two things now, person and then residential status. Let's talk about person. Person includes. So again, we have an extensive definition over here. Person includes. It includes what now? It includes individual, HUF, company, firm, AOP or BOY, AJP, BOA, same BOA, owned or controlled by such person. Once again, what does person includes? Person includes totally 7 boxes, guys. It includes individual, HUF, company, firm, AOP, BOY, AJP, then BOA, basically branch, office, agency, owned or controlled by these people. So these 7 things are coming under the umbrella of person. Now listen to me. Agency, office and branch, nothing but your BOA, does not have an independent status separate from its owner. It is still considered as a person. Like for example, let's say there's a company. This company has a branch. Actually speaking, technically speaking, one entity only, guys. But however, from the point of view of FEMA, they will be considered as separate persons. Understanding? Actually, they are not independent. Actually, they are one and the same. I mean, the branch is considered to be a part of the company. But however, from the point of view of FEMA, they will be considered as two different persons. Okay. So, person includes, tell me last time, individual, HUF, company, firm, AOP, BOI, AJP, and then BOA owned or controlled by these people. Now, BOA does not have independent status. But from the point of view of FEMA, BOA is considered as a separate person altogether. Okay. Now, these persons, guys, some of them will be resident, some of them will not be resident. So either they will be person resident in India or they will be person resident outside India. Either they will be person resident in India or they will be person resident outside India. And this is what brings us to one of the most important discussions in this chapter, which is residential status. See guys, when it comes to residential status, we will learn it in two parts. We will first focus only and only on the residential status of individuals. Okay, we will finish this first, then only we will go to the residential status of other persons. So when it comes to residential status of individuals, I have totally 3 provisions. 1, 2 and 3, I have 3 provisions. But however, I have to ensure that I always go in this order. Are you noticing my arrow? Basically, I will try fitting my individual in this in this last bucket first. If it doesn't fit under this bucket, only then I will come to this second bucket over here. Only if it doesn't fit under this bucket also, only then I will talk about this third bucket over here. Understanding? So we will always go in this sequence. Let me give you one small disclaimer before we begin. Let me tell you that the way in which we calculate, the way in which we check the residential status of an individual practically, and the way in which I'm going to be discussing with you now academically, they're going to be totally different. But we don't have a choice. We have to stick to the ICAI's method. So the same ICAI's method only I'm following and I'm discussing it with you over here. Okay. Now the very first thing I will check is, has my individual come to India in the current year or is he staying in India in the current year? If he has not come to India in the current year, then I will straight away send him to the second box, guys. But let us say he has come to India in the current year. If he's come to India in the current year, I will ask him, why did you come to India? He is saying, I came to India for three purposes. What are these three purposes? I'll discuss with you. Wait a minute. But he's saying that he's come to India for three purposes. If he's come to India for three purposes, I will not check anything else. I will straight away call him as a person resident in India. But if he's come to India, not for any of these three purposes, guys, he's come to India for any other purpose, again, I will not check anything. I will straight away call him as PROI, person resident outside India. So the first thing I will ask him is, did you come to India in the current year? Did you stay in India in the current year? If he says yes, then I will ask him, why did you come to India? He's saying, I came to India for three purposes. I will not check anything else. I will straight away call him as PRI. But if he's saying, I came to India for any other purpose, then I will not check anything else. I will straight away call him as PROI. Okay, guys. But he's saying, no, I did not even come to India. Which means this box will not apply, guys. Which means I'll have to come to the second box over here. If he did not come to India in the current year, I will ask him, did you go out of India in the current year? Did you stay out of India in the current year? He's saying, yes, I went out of India. I stayed out of India in the current year. So if he went out of India, I'll ask him, why did you go out of India? What was your reason? He's saying, I went out of India for three purposes. If he says he went out of India for three purposes, I will not check anything else. I will straight away call him as PROI. See, guys, if you come to India for three purposes, I will call you PRI. So obviously, if you go out of India for the same three purposes, ulta, I will call you PROI. Okay. But he's saying, no, I went out of India, but not for three purposes. That is, he's saying he went out of India for any other purpose. Then in that case, guys, I can't make any conclusion directly. I will have to check for how many days did he reside in India in the preceding financial year. Did he reside in India in the preceding financial year for more than 182 days? If yes, then he will become a PRI. If he, however, resided in India in the preceding financial year for less than or equal to 182 days, then he will not be PRI. Okay, but then however, what if he has neither come to India in the current year nor is he going out of India in the current year? Then I will straight away come to this first box over here. I will simply check over here, did he reside in India in the preceding financial year for more than 182 days? If yes, he will become a PRI. If no, he will become a PROI. Now see, guys, this is your entire residential status of individuals chart. Many of you will be finding this difficult right now. Many of you would already be demotivated to continue watching. Many of you would have already made a decision, okay, not happening, not understanding, let me quit, let me leave this. But listen to me, it is hard only till it is easy. Initially, there will be some discomfort. If you give up in that discomfort, then you will never understand the concept. But however, if you persist in that initial discomfort, if you continue to put in effort despite that initial discomfort, you will not even realize how the same table, the same chart over here becomes your biggest strength, guys. So just persist for a few more minutes and I can challenge you guys, not one of you will exit this video unhappy. I can challenge you. So please, no matter, despite the fact that you didn't understand anything over here, I request you, please persist. Initial 5 minutes, guys, and then you will yourself tell me that yes, residential status, I will never ever make a mistake. You will really become a pro in this. You just got to persist and stay despite the initial discomfort. Listen to me, guys. Very simple. The first of all, you're talking about whose residential status. We're talking about the residential status of individuals. Now, if it is residential status of individuals, the first thing that you will check is, has this individual come to India in the current year or preceding financial year? Current year. You will check, has he come to India in the current year? Yes, he has come to India in the current year. You will apply this chart. But no, he did not come to India in the current year. Then you will go to the second chart, guys. You will ask him, okay, fine, did you leave out of India in the current year? If he says, yes, I left India in the current year, then you will apply the second chart. But if he's saying, no, I neither came to India nor I left India, then you will straight away come to the first box. First, this sequence is clear. Now listen, if your individual says that yes, he came to India in the current year, you will ask him why he came to India. If he came to India for three purposes, he will become PRI. If he came to India for any other purpose, of course he will become PROI. But then no, he did not come to India. So you will ask him, did you leave India in the current year? He is saying, yes, I left India in the current year. You will ask him, why did you leave India? Now see, when he comes to India for three purposes, you call him PRI. So obviously, when he leaves India for the same three purposes, obviously you will call him PROI, guys. But what if he is leaving India for any other purpose? If he is leaving India for any other purpose, then you will apply this blue chart over here. Ignore this dabba. If he's leaving India in the current year for other than these three purposes, for any other purpose other than these three purposes, then you will straight away apply this blue box over here. What does the blue box say? In the blue box, guys, we don't look at the current year. Here we look at the preceding financial year. We will check in the preceding financial year, did you reside in India for more than 182 days? I am not saying at least 182 days. I am saying, did you reside in India for more than 182 days in the preceding financial year? If yes, you will become a PRI. If no, you will become a PROI. Now come on, let's try to understand what are these three purposes. Again and again we're talking about three purposes. What are these three purposes? These are those three purposes, guys, which have some element of permanence. These are those three purposes which have an element of permanence. Like for example, number one, you're coming to India to take up employment. Like you're coming to India for three purposes, let us say. So you're coming to India for taking up employment, or you're coming to India because you want to carry on a business or a vacation, or you're not vacation, vocation. Vocation is something similar to profession or business, okay? Or you're coming to India for any other purpose, but you're coming to India for an uncertain period. So whenever you're coming to India with an element of permanence, like we don't know when you will go back. You're coming to India without a return ticket. So you're coming to India because you want to take up employment here. You're coming to India because you want to carry on a business or a vocation here. Or you're coming to India for any other purpose, but indicating some uncertainty in your stay in India, then that will become three purposes. So if you're coming to India for any of these three purposes, you will immediately become a PRI, guys. I won't check anything else, you will become a PRI. But if you're coming to India for not any of these three purposes, like you're coming to India just because you want to, meet your parents and then you're going to go back, or you're coming to India just to visit one temple and then you will go back. In that case, you're coming to India but not for any of these three purposes. In that case, you will straight away become a PROI. Okay guys, now listen to my second part. What if you have not come to India in the current year? Then I will ask you, okay, did you leave India in the current year? You are saying yes, I left India in the current year. I will ask you, why did you leave India in the current year? You are saying I left India, same three purposes, guys. I left India because I want to take up employment outside India. Or you're saying I left India because I want to start a business outside India. Or you're saying I'm leaving out of India for any other purpose, but I don't have any plans of coming back. I'm leaving India in the current year. For some uncertain period, I'm leaving India. So if you're leaving India for three purposes, again, you're leaving India with some permanence element, guys. So we'll shut the doors behind you, your PROI. But you're saying you left India. Yes, you left India in the current year, but not for these purposes. Let's say you left India just because you wanted to go to Vietnam for a vacation and then you will come back. So you're not leaving India with an element of permanence. You're leaving India in the current year, but you have a return ticket. You will come back. So if you're leaving India in the current year and not because of any of these three reasons, then I will come to the first box over here and I will see how many days you resided in India in the preceding financial year, and on that basis I will make a decision. Understanding, guys? So what are the three purposes? The three purposes are those three purposes which indicate some element of permanence, like either number one, employment, or number two, business or vacation, and number three, any other purpose but indicating some element of uncertainty. Alright guys, now see, when it comes to residential status under Income Tax Act, there we talk about at least 182 days, right guys? But here we're talking about more than 182 days. Point number one. Point number two, please notice in my first box, in my first two boxes over here, we're talking about did you leave India in the current year, did you come to India in the current year? But when I talk about how many days you resided in India, 182 days criteria, there I'm asking about the preceding financial year. Be careful about this. Then, whether you are an Indian citizen or not, it is irrelevant for my entire discussion. And a very important point in Income Tax Act, we find your residential status for a year. So if you're a resident for the entire year. If you're non-resident, you're non-resident for the entire year. But that is not how it is in FEMA. In FEMA, we find your residential status on a particular date. Like for example, when you come to India for these three purposes, then on that date, you will become a PRI. Before that date, you were PROI. Understanding, if you come to India for any other purpose, on that date, you are PROI. So in FEMA, we are checking your residential status on a particular date. In a year, let's say 24-25, in 24-25, in January, you may be a resident. Next day in February 1st itself, you may become a non-resident. So within the year itself, your residential status can change in FEMA. It is not that way in income tax. In income tax, you find the residential status for a year, right guys? But in FEMA, you find the residential status for a day. So each day your residential status can change in FEMA. Okay, now see, as of now, we will be having only some 50% clarity in this concept. As of now, we will not be having 100% clarity. Now I'm going to discuss with you a couple of examples. With these examples, your clarity level will reach 75%. Okay, and then I will be doing some concept tests with you, and this is where you will be reaching the extreme level of clarity. So despite it being a revision video, guys, I assure you that you will exit this only after getting 100% clarity. Okay, listen to me, look at my example. Mr. John lived in India in 2021 for more than 182 days. He has lived in India in 2021. Hence, for financial year 21-22, he is a resident. But in 21-22, on 1st November 21, he left India for employment in Dubai. Come on, guys, tell me. He left India for employment. Now, I want to know his residential status. I want to know his residential status. In 21-22 alone, I want to know his residential status. What will your answer be? You will go in the sequence. You will first ask him, did you come to India in the current year? Which year are we talking about? 21-22. In 21-22, did you come to India? He is saying, no, I did not come to India. So that first box out of the picture. Then you will ask him, okay, did you leave India in the current year? Did you leave India in 21-22? He's saying, yes, I left India. You will ask him, why did you leave India? He's saying he left India for employment, guys. He left India for employment in Dubai, which means he left India for one of those three purposes. What are those three purposes, guys? Employment, business or vocation, or any other purpose indicating some uncertainty. So he has left India in 21-22. He has left India for those three purposes. You will not check anything else, guys. Once he leaves India for any of those three purposes, he will become a PROI. Understanding? Before this, he was PRI. Before he left India, he was PRI. But once he leaves India for any of those three purposes, that is what we have in our chart over here. If you're leaving India for those three purposes, I will not check anything else. You will straight away become a PROI. Story over, guys. Now let's say next month he comes back to India. Next month he comes back to India for those three purposes. Now again he will become a PRI. Understanding? So every day like this, your residential status can change. Now come to my second example. Mr. John came to India on the 1st of June 2021 to visit his parents. So tell me, guys, 1st June 2021, when he comes to India, will you call him as a PRI or a PROI? Sequence. You will first ask him, did you come to India in the current year? Yes, guys, in 21-22 he has come to India. So you will ask him, did you come to India for any of those three purposes? Did you come to India for the purpose of employment? He's saying no. Did you come to India for the purpose of business or vocation? He's saying no. You're asking him, did you come to India with any with an uncertain element? No. He's saying, I've come to India to visit my parents and then after that I will go back. So he's come to India but not for three purposes. So if you come to India for any other purpose, I will not check anything else. You will straight away be a PROI. So on 1st June 2021, he's a PROI. Then what happened? His parents fell sick and he stays till 31st March 2022. But he continues to stay in India. But it is certain that he will leave India in the next 6 months. So he is staying in India. He continues to stay in India. But is he staying in India for the purpose of employment? Is he staying in India for the purpose of business or vocation in India? Is he staying in India for an uncertain period? No, guys, it is certain that next 6 months he will leave. So because he is staying in India but not for any of those three purposes, he is still a PROI. Right, guys? If you come to India or if you stay in India but not for those three purposes, for any other purpose, I will not check anything else. You will be a PROI. Are you following? If you come to India for three purposes, I will not check anything else. You are PRI. If you come to India for any other purpose, I will not check anything else. You will be PROI. He came to India not for three purposes. He came to India only to visit his parents. So not for any of the three purposes. So he will be PROI. He continues to stay in India but not for any of those three purposes. He will stay PROI. Only when you come to India or only if you stay in India for any of those three purposes, only then you become a PRI. Okay, guys, now come to my next example. Mr. John comes to India on 1st June 21 for employment, business or circumstances which indicate his intention to stay in India for an uncertain period. As soon as you come to India, see 1st June 2021 he's coming to India. I'm asking him, did you come to India for any of those three purposes? He's saying yes. If you come to India for any of these three purposes, will I check your preceding financial year and all? No, guys. As soon as I see you're coming to India in the current year, immediately I will apply this box over here. So because he's coming to India in the current year and he is coming to India for three purposes, I will straight away conclude what? I will straight away conclude that 1st June 2021 onwards, he has become a PRI. Okay, now come to this example. This is the example which will give you an extreme level of clarity. Mr. John resided in India in 1920 for 180 days. He came to India on 1st April 2020 for carrying on business. Come on, tell me. 1st April 2020, guys. He is coming to India. 1st April 2020, he's coming to India for carrying on business. He's coming to India in the current year. Let's say my current year is 2021. So in 2021, in my current year, he's coming to India. I'm asking him, did you come to India for any of the three purposes? Guys, he has come to India for carrying on business. This is one of the three purposes. So because he's coming to India to carry on business, because he's coming to India for three purposes, even though preceding financial year he has stayed in India for less than 182 days, still it's okay. Because he's coming to India for any of those three purposes, I will not check anything else, guys. I will straight away call him as PRI. Are you noticing in the preceding financial year 1920, he has stayed in India for 180 days only? Has he stayed in India for more than 182 days in the preceding financial year? No, guys. No. But that doesn't matter. Why? Why doesn't it matter? Because when you come to India for three purposes, I don't check anything else. I straight away call you PRI. Now are you understanding little? Yes, guys, if you're coming to India for any of the three purposes, you will straight away become PRI. Then the question says he intends to leave the business on 30th April 21 and leave India on 30th June 2021. So see, guys, when is he leaving India? 30th June 2021. When you leave India, what do you ask him? Why are you leaving India? Have they given you the reason why he's leaving India? No. They have just mentioned that he is going to leave India on 30th June 21. They've not told you why he's leaving India. So there are two possibilities, guys. We have to make an assumption now. We don't know why he's leaving India. So either he will leave India for those three purposes, or he will leave India for any other purposes, not for those three purposes. So if he's leaving India for those three purposes, you will not check anything else, guys. You will straight away say you're a PROY. Once you leave India, you will become a PROY. But however, what if he's leaving India for any purpose other than those three purposes? Then in that case, we will look at the preceding financial year. What is the preceding financial year? He's leaving India on 30th June 21, which means he's leaving India in the financial year 21-22. So the preceding financial year will become financial year 2021. In 2021, we will see how many days has he resided in India. If he has resided in India for more than 182 days, then he will become a PRI. But if he resided in India for not more than 182 days, then he will become a PROY. Right, guys, do you recall? This is what we learned over here. If he's leaving India for those three purposes, then he will become PROY. But if he's leaving India not for those three purposes, then I will check how many days he's resided in India in the preceding financial year. That is, I will straight away come to my blue box over here. That is what I did over here. If he's leaving India for three purposes, he will become a PROY. I won't check anything else. But if he's not leaving India for those three purposes, if he's leaving India for any other purpose, then I will see preceding financial year how many days has he stayed in India. Come on, check, guys. In 2021, how many days he stayed in India? You can't say 180 days because 180 days was in 1920. What about 2021? 2021, if you see, he came to India in the beginning itself, 1st April itself, and he's leaving only in 21-22. So 2021, full 365 days he has been in India. So 2021, preceding financial year, full year he has been in India. Clearly he has been in India for more than 182 days. So therefore he is going to be a PRI. Understanding? So first of all, when he came to India for the three purposes, he became a PRI. Then when he leaves India on 30th June 21, we don't know why is he leaving India. So we are giving our answer from both the points of view. If he's leaving India for three purposes, he will become a PROY. But if he's leaving India for any purpose other than the three purposes, then we will see preceding financial year. Preceding financial year, how many days have you resided in India? On that basis, we'll give our answer. Okay. Now see, come to this example first. Then we'll go to the one that I skipped over here. The question says, Miss Julia is an air hostess with the British Airways. She flies for 12 days in a month and thereafter takes a break for 18 days. So 12 days she's working, 18 days she's taking a break every month. During the break, she is accommodated in a base which is normally the city where the airline is headquartered. However, for security considerations, she was based at Mumbai. Till here, did you understand the question? She's an air hostess. She flies for 12 days and then she takes a break for 18 days. When she's taking the break for 18 days, the airline accommodates her at some place which is generally the city where the airline is headquartered. But however, this time she was brought to Mumbai. So guys, she has clearly come to India in the current year. So because she has come to India in the current year, which box will you apply? You will apply the first box over here. She has come to India in the current year, guys. You will apply this box. So you will ask her, why did you come to India? Tell me, guys, why has she come to India? Has she come to India because she wants to take up an employment in India? No. Has she come into India because she wants to start a business in India? No. Has she come to India for an uncertain period? No, guys. As soon as her 18 days break is over, she's going to go back. So, none of the three purposes. So, she has come to India, but is it any of the three purposes? No. So, you will not check anything else. Had she come to India for three purposes, you would have called her a PRI straight away. But because she's coming to India for any other purpose, you will straight away call her a PROI. Story over. The question says, during the financial year, she was accommodated at Mumbai for more than 182 days. Does it matter to you? Doesn't matter to you. The fact is, she has come to India in the current year. She has come to India for a purpose other than the three purposes. Therefore, she's straight away PROI. Story over, guys. You're following. So I'm straight away applying my sequence in every question. If you see, I'm straight away applying my sequence. If your individual has come to India in the current year, I'm applying this part. If your person is leaving India in the current year, I'm applying this part. But if your person is neither coming to India nor leaving India in the current year, then I'm checking this last table over here. Getting it? So the most interesting point over here was this air hostess example, and also this Mr. John example, this one where he's coming to India and he's also leaving India. So when he's coming to India in 2021, we checked. Then when he's leaving India in 21-22, again we checked. Basically, your residential status can keep changing every day. So whenever a situation happens, whenever some event happens, we will check your residential status under FEMA. Alright, now come on, there was one point which we skipped over here. Let's have a look at this. See guys, through this point you're going to have a tiny learning, okay? Generally, what have we learned? That when a person leaves India, if he leaves India in the current year, if he's leaving India for any of those three purposes, if he's leaving India for any of those three purposes, you will call him as PROI. Yes guys, now to these three purposes, one more purpose we are adding, and this is not because of FEMA, but this is because of RBI circular. RBI circular says if a student is leaving India because he wants to take up education outside India, we will not check anything else. We will straight away call him as PROI. See, we can't say when a student is coming to India also same thing we will apply. We can't say. RBI circular is only for students who are leaving India. So if you are a student who is leaving India for the purpose of education, I will not check 182 days criteria and all. I will straight away consider that student as if he is PROI. Okay, this was one small point because of RBI circular. Alright, now this is it about the residential status of individuals, guys. Can we do one quick revision of the entire thing? 1 second, let me get a fresh page and let's do it over here. What are we doing? A quick revision of the entire residential status of individuals. Okay, listen to me now. So first of all, we know that person, when it comes to a person can be an individual, HUF, AOP, BOY, AJP, can also be a branch, office or an agency. Basically, we learned that generally BOA doesn't have independent status, but for the purpose of FEMA, we give BOA also independent status, we learned. Now, these persons can either be persons resident in India or they can be persons resident outside India. Right, guys? Now, out of these persons, we are right now focusing only on individuals, right? So for individuals, what is the first thing you will check? First thing you will check is, did this individual come to India when? Current year, last year? Did he come to India in the current year? If he came to India in the current year, you will straight away ask him, why did you come to India? If he came to India in the current year for three purposes, you will not check anything else. You will straight away call him as PRI, guys. 182 days criteria becomes irrelevant over here. But if he comes to India for any other purpose, then you will again not check anything else. You will straight away call him as PROI. Even over here, 182 days criteria is irrelevant. But however, if he is not coming to India, then you will ask him, did you leave India? Did he leave India? Same thing in the current year. If he left India in the current year because of three purposes, then you will not check anything else. You will straight away call him as PROI. One more new point we learned over here. If he is leaving India for the purpose of education outside India, here also you will not check 182 days criteria. You will straight away call him PROI because of the RBI circular. But if he is leaving India for any other purpose, then in that case, you will apply the 182 days criteria, guys. On that basis, you will decide. Then comes my third part. What if he is not fitting under the first bucket? That is, he did not come to India in the current year. Also, he is not fitting under the second bucket. That is, he did not leave India in the current year. Then in that case, you will straight away say, how many days did he reside in India? How many days did he reside in India in the preceding financial year? If he resided in India in the preceding financial year for more than 182 days, then he will become a PRI. But if he resided in India for less than or equal to 182 days, then he will become a PROI. So this was your entire three-step approach with respect to residential status of individuals. Then we learned, under FEMA, we don't check the residential status for a year. The residential status can keep changing every day also. So it is on a day basis, not year basis. Then one more thing we learned, citizenship is going to be irrelevant, and be very careful guys. In Income Tax Act, we say resident means you must stay in India for at least 182 days. But in FEMA, we are saying we should stay in India for more than 182 days. Be careful, this one small difference in the sign can make a big impact in your answer. Okay. So this was our entire learning about residential status of individuals. And by the way, what are these three purposes? When we keep saying three purposes again and again, number one, employment. Number two, business or vocation. Number three, any other purpose, but it indicates an uncertain element. So these are the three purposes which we're talking about. Alright, education point also is communicated to you, and yeah, all these I've discussed with you. Now come to the next part. So this entire discussion was about individual guys, but what if your person is not an individual? Like what if your person is a company? For non-individuals, how will you find the residential status? That is what our next discussion is going to be. What if your person is not an individual? If your person is not an individual, it is the easiest discussion guys. The whole complication, the whole confusion is only for individuals. For non-individuals, it's extremely simple. You will simply see where is that entity incorporated. If the entity is incorporated in India, that entity will become PRI. That's all guys. If that entity is incorporated outside India, that entity will become PROI. Understanding guys? See, I'll repeat again. If that person, like for example, let's say company. If the company is incorporated in India, it will become PRI. So Reliance Industries Limited, PRI. Tata Motors, PRI. Infosys Limited, PRI. Wipro, PRI. ITC Limited, PRI. If it is incorporated in India, it will become a PRI. But if it is incorporated outside India, it will become PROI. So Apple Inc., PROI. Tesla, PROI. Incorporated outside India, they will become PROI. Okay. Then apart from this, we have to talk about BOA also, because we know that BOA generally is not independent, but FEMA gives independent status to BOA. Even BOA is considered as a separate person altogether. So we have to understand the residential status of BOA also. For BOA also, it's very simple. If the BOA is in India, okay, doesn't matter who owns it, doesn't matter who controls it. If BOA is in India, straight away it will become PRI. If the BOA is outside India, but if it is owned or controlled by PRI, it will again become a PRI. So in other words, when it comes to BOA, it must have some connection with India guys. Either it should be in India, it will become a PRI, or even if it is outside India, but if it is owned, controlled by PRI, it will become a PRI. So some Indian connection is required, it will become a PRI. Now look at this. Straight away answer this entire non-individuals part. This part of your discussion will become perfectly fine with this discussion. Listen to me. There's a company incorporated in India. If it is incorporated in India, it will become a PRI guys. If it is incorporated outside India, it will become PROI. This we know very well. Now look at this. There's a branch, office or agency, BOA, in India. If the BOA is in India, does it matter who owns it, who controls it? BOA is in India guys. It will immediately become PRI. BOA is in India. It is owned, controlled by Indian company, owned, controlled by foreign company, doesn't matter. Doesn't matter who owns it, doesn't matter who controls it. BOA is in India, it will straight away become a PRI. Okay, now BOA is outside India. If it is outside India, we'll have to see who owns it, who controls it. If it is owned or controlled by a PRI, then it will become a PRI guys. So BOA is outside India. It is owned, controlled by Indian company. Now Indian company means what? It is incorporated in India. If it is incorporated in India, Indian company will become PRI. So my BOA is owned or controlled by PRI. It is outside India, but it is owned or controlled by PRI. So therefore that BOA will also become PRI. Right guys? So this is my point over here. If the BOA is outside India, but if it is owned or controlled by PRI, then that BOA will also become a PRI. So in my situation over here, BOA is outside India and it is owned or controlled by Indian company. Indian company means a company incorporated in India. If it is incorporated in India, that Indian company will become a PRI. So if a BOA is outside India, but it is owned or controlled by a PRI, that BOA will also become a PRI. And lastly, BOA is outside India guys. If it is outside India, you will see it is owned or controlled by whom? Owned or controlled by foreign company. Foreign company means a company incorporated outside India. If the foreign company is incorporated outside India, the foreign company will become PROI guys. So BOA, it is outside India. It is also owned or controlled by PROI. This BOA will become PROI. So if the BOA is outside India, that BOA will become PRI only if it is owned or controlled by another PRI. Okay, so this is it, guys. This is our entire residential status discussion. For individuals, also, we have discussed. For non individuals, also, we have discussed. And now I'm going to take up some concept test questions for you. These concept test questions will not be just from residential status, but from the beginning of our FEMA discussion till here. Some selected points I have taken, and we're going to be doing a nice concept test discussion just to ensure that our clarity is at the peak. Okay, come on. FEMA, what is a year? FEMA 1999, guys. FEMA 1999, but it came into force when? It came into force on the 1st of June 2000. So, are you noticing? FEMA 1999 came into force on 1st June 2000. Similarly, LLP Act also, LLP Act 2008, but it came into force on 31st March 2009. So, be careful, okay? Then, remember foreign security. So, foreign security means what? It is security which is denominated or expressed in foreign currency. It also includes security which is denominated or expressed in foreign currency, but return or redemption is in INR. Even that is foreign security. So now I have 4 situations for you. You have to say whether it is foreign security or not. Just giving you a reminder, we had learned that in foreign security, it doesn't matter your return redemption is in what currency. What matters is, what is more important is that the foreign security has to be denominated in foreign currency. Right, guys? So it has to be denominated in foreign currency. That is a primary factor. Keep that in your mind and come on, have a look at this. There's a foreign security. It is denominated in dollars. The return and redemption is also in dollars. Will it be foreign security? Yes. It is denominated in dollars. The return and redemption is in INR. Will this be foreign security? Yes, guys, this is what is covered in the includes part. In the includes part, we learned that if there is a security which is denominated or expressed in foreign currency, but return or redemption in INR, even this will be included under foreign security. And then, third situation, it is denominated in INR, but return and redemption is in dollars. Will this be foreign security? No. Why no? Because for it to become a foreign security, what is more important? To become a foreign security, what is more important is that it should be denominated or expressed in foreign currency. It is denominated it is denominated or expressed in INR. I won't even check anything else, guys. It will not be a foreign security. Understanding? Just wanted to give you a reminder of this. For it to be a foreign security, the primary criteria is that it should be denominated or expressed in foreign currency. If it is denominated or expressed in Indian currency, doesn't matter in what currency the return or redemption is, it will not be foreign security. But if it is denominated or expressed in foreign currency, doesn't matter in what currency the return or redemption is, it will be foreign security. Understanding? Now come on. In Income Tax Act, 182 days, what sign should I put? You should stay in India in the previous year for at least 182 days, guys. But in FEMA, you should stay in India in the preceding financial year for more than 182 days. Okay? Then, is citizenship relevant? In our entire residential status discussion, is citizenship relevant? No, citizenship is irrelevant, we discussed. Then, an individual comes to India for 3 purposes. What will be his residential status? He comes to India for 3 purposes. You will not check anything else, guys. You will straight away call him as PRI. Then, an individual leaves India for 3 purposes. You will not check anything else, guys. You will straight away call him PROY. Basically, in these 2 situations, 182 days criteria becomes irrelevant. Okay, now come on, guys. This is going to be our master chart for residential status of individuals. It covers the entire sequence I discussed with you. It covers one final time, guys, residential status of individuals. Do it with me, please. The first thing that you will check, did he come to India in the current year? In the current year, did he come to India? This is the first thing that you will check. Yes, he came to India in the current year. You will ask him, why did you come to India? He's saying, I came to India for 3 purposes. What will you immediately call him? You will not even check 182 days criteria. You will straight away call him as PRI, guys, because he's coming to India for 3 purposes. But he's coming to India not for 3 purposes. Again, you will not check anything else. You will straight away call him PROY. Even over here, 182 days criteria, irrelevant, guys. But however, you asked him, did he come to India in the current year? No, he did not come to India in the current year, guys. So then you will check, did he leave India in the current year? Yes, he left India in the current year. If he left India in the current year, again you will ask him why he left India. He left India for 3 purposes. You will not even check the 3 criteria. He left India for 3 purposes. You will straight away call him as PROI. But however, what if your individual has left India in the current year, but not because of 3 purposes? Then you will look at the 182 days criteria straight away, guys. Now coming to the third bucket, what if your individual has neither come to India in the current year nor he has left India in the current year? Then in that case, you will straight away apply the 182 days criteria. Now what is this 182 days criteria? You will see in the preceding financial year, not previous year, I should say preceding financial year. In the preceding financial year, your individual has stayed in India for how many days? Has he stayed in India for more than 182 days? If yes, then he becomes a PRI. If he has stayed in India in the preceding financial year for less than or equal to 182 days, then he will become a PROI. So guys, in conclusion, when do you check the 182 days criteria? Let me summarize it for you over here. When is 182 days criteria relevant? When your person comes to India, it is not relevant at all. Doesn't matter what is the purpose, 182 days criteria is not relevant. So when is it relevant? It is relevant only in two situations. Number one, when your individual is leaving India and he is leaving India not for those three purposes, he is leaving India for any other purpose. Then you check the 182 days criteria. Second situation, if your individual in the current year, he is neither coming to India in the current year, nor is he leaving India in the current year, then also you will look at the 182 days criteria. Simple now, 182 days criteria, this red box over here will be relevant when? If you come to India, doesn't matter, the 182 days criteria will never be relevant. But if you're leaving India for other than three purposes, then 182 days criteria will be relevant. Also, if you're neither coming to India nor are you leaving India, then also the 182 days criteria will be relevant. So only in two situations only 182 days criteria will be relevant. Okay guys, now come to my last concept test for you, residential status of BOA, branch office agency. We know that even though they actually don't have independent status, but FEMA gives them independent status. Now how do you determine the residential status of BOA? If it is owned or controlled by PRI, doesn't matter where this BOA is situated guys. If it is owned or controlled by PRI, it will directly become a PRI. If it is owned or controlled by PROI, you will see where is it situated. If it is situated in India, doesn't matter who owns it, doesn't matter who controls it. If it is situated in India, it will always become a PRI. But however, if it is outside India, see guys, it is owned or controlled by PROI and it is also situated outside India. No India element. Owned also by PROI, situated also outside India, gone PROI. Okay guys, now the same thing, left to right, now right to left. Okay, same thing, just a different point of view. The BOA is situated where? BOA is in India. Some India element guys, it will become PRI. Because if you notice, if it is in India, even if it is owned by PROI, it is still becoming PRI, right? So if the BOA is in India, it will always be PRI. Doesn't matter who owns it, doesn't matter who controls it. But if it is outside India, then we will see it is owned or controlled by whom? If it is owned or controlled by PRI, then it is outside India, but it is owned by PRI. Some India element guys, it will become a PRI. But if it is outside India, also owned or controlled by PROI, then only it will become PROI. So if I have to summarize this for you, very simple summary I can make for you guys. When will BOA be PROI? BOA will be PROI if it is situated outside India and it is owned or controlled by PROI. Only if both of these conditions are fulfilled, only then BOA becomes PROI. This is like a summary, like how I've summarized for you over here, right? When will 182 days criteria apply? Finally, only in two situations. Same way I'm summarizing it for you over here, that when it comes to BOA, when will BOA be PROI? BOA will be PROI only if both these conditions are fulfilled. Number one, it should be outside India and it should be owned or controlled by PROI. Only then it will become a PROI. Okay guys, so with these summaries, you should be pretty confident right now. Now come on, have a look at this example over here relating to purely non-corporates. The question says Toy Limited is a Japanese company. So Toy Limited, Japanese company guys, incorporated in Japan. So therefore Toy Limited will definitely be PROI because it is not incorporated in India. It has a robotic unit with headquarters in Mumbai. So it has, I can say it has a BOA. It has a BOA in Mumbai. So because it has a BOA in Mumbai, this BOA will become PRI because the BOA is situated in India. Now this Toy Limited also has a branch in Singapore. So it also has a BOA in Singapore. Then the question says the headquarters at Mumbai controls the Singapore branch. So the Singapore branch is owned or controlled by whom? The Singapore branch is owned or controlled by PRI. So because it is owned or controlled by PRI, the Singapore branch will also become PRI now because it is owned or controlled by PRI. Then the question says the Singapore branch controls an office in China. So Toy Limited has one more BOA and that BOA is in China. This China BOA is owned or controlled by the Singapore branch. Singapore branch is PRI. PRI owns or controls this China branch. So this China branch also will become a PRI. Why? Because it is owned or controlled by a PRI. What would be the residential status of the robotic unit in Mumbai, Singapore branch and China office? So come on guys, the branch office in Mumbai is PRI. Why? Because it is in India. If the BOA is in India, it will become a PRI. Okay. Then what about the Singapore branch? The Singapore branch is also a PRI. Why? Because it is owned or controlled by PRI. That is why it becomes a PRI. Then what about the China branch? The China BOA is also PRI. Why? Because it is owned or controlled by PRI. So in simple words, BOA, either if it is in India, it will straight away become a PRI. Also, if it is owned or controlled by PRI, in this situation also it will become a PRI. We know the summary guys. When will BOA be PROI? BOA will be PROI only if it is situated outside India and it is owned, controlled also by PROI. Only then the BOA will become PROI. So here if you see the Singapore branch, yes it is outside India, but it is not owned, controlled by PROI. It is owned, controlled by PRI. That is why it becomes a PRI. Similarly, if you see the China branch, yes, it is outside India, but is it owned, controlled by PROI? No, it is owned or controlled by a PRI. If it is owned or controlled by PRI, it will become a PRI. Okay, so with this, I think residential status pretty confident, guys. Yes, so I think we've completed all the points under the residential status part. So until now, if you see, we are done learning with number one, the initial part, the preamble, then when did the act commence, the extent, application, all that, salient features. Then we learned the four small definitions, authorized person, then your import, export, and currency. Then we learned two really important definitions, Forex and Forse. And now we completed the biggest and the most important concept in this chapter, which is residential status. I think by the end, with all these concept tests and all these charts and summaries, I'm very sure you're pretty confident. Now with the same confidence level, come on, let's go on into the remaining concepts of FEMA one by one. Now first of all, we have this very interesting concept over here about dealing in foreign exchange. I'll give you one brief idea about it, okay? Now the FEMA, the act does not want you to buy or sell foreign exchange or foreign securities in a very casual manner. No. If you want to buy foreign exchange, do it only through an authorized person. If you want to sell foreign exchange, sell it only through an authorized person. Similarly, if you want to trade in foreign securities, do only through an authorized person. They don't want you to casually buy and sell. They want to properly regulate this whole foreign exchange and foreign securities. So regarding this only, they have put 5 restrictions on us, guys. 5 restrictions. The section says that no person shall, number 1, deal in or transfer Forex or Forse to any person who is not an authorized person. I'll help you understand. Like for example, can you sell dollars to your neighbor? Can you buy pounds from your friend? No. Only banks, authorized dealers, authorized persons, only they can do it. So your first point is no person shall deal in or transfer Forex or Forse to any person who is not an authorized person. If you want to buy dollars, you can buy dollars only through an authorized person. If you want to sell euros, you can sell euros only through an authorized person. You can't randomly buy and sell foreign exchange with your neighbors or with your friends or with your customers. You can't do deal in foreign exchange so casually. Then comes a second restriction. No person shall make payment to PROI or no person shall make payment for the credit of PROI. There are two things over here. No person shall make payment to a PROI. Also, no person shall make payment for the credit of PROI. I'll give you an example for both of them, okay? See, let us say I want to send money to a university in UK. I have to pay my education fees. I have to pay my academic fees. Can I directly do the transfer to the UK university? No, it has to be through a bank, through an authorized person. So no person can directly make payment to a PROI. No person can directly make payment to a PROI. Similarly, no person can make payment for the credit of PROI. Like for example, let's say There's a PROI. He has taken a life insurance policy from LIC. Okay, so to LIC he has to pay his life insurance premium. So can I tell this PROI, no, no, why are you taking the unnecessary trouble? I'll itself pay from here itself directly. We can't do this. Not allowed, because see, if the PROI, if he makes payment of his life insurance premium in India, then don't you think Forex will flow into India, guys, through him? But however, if I tell him, no, no, you don't make the payment of foreign exchange in India, I'll do one thing, I'll pay premium on your behalf, later you can pay me, that is not allowed. Because if I directly pay the life insurance premium of this PROI to LIC, then don't you think I directly paid off in INR? So that Forex, which could have otherwise flown into India, will not flow into India. So that is why no person shall, number one, no person shall deal in or transfer Forex or Forse to any person other than authorized person. Second point, no person shall make payment to PROI. Also, no person shall make payment for the credit of PROI. For the credit of means on behalf of. No person shall make payment on behalf of PROI. You can do all this only through authorized persons. You can't do it on your own. Then comes the third point, no person shall receive payment from PROI. Payment can be received only through authorized person. Corresponding inward remittance is required. Imagine you own a restaurant, okay? You run a restaurant. One foreign tourist came to your restaurant, had, let's say, tea in your restaurant. Now, the foreign tourist is paying you $10. Can you take the $10 from him? No, you can't receive payment from PROI. You can't receive foreign currency from PROI. If you have to receive payment from PROI in foreign currency, you can receive through authorized person only. Then lastly, you cannot enter into any financial transaction in India as consideration for the acquisition of an asset outside India. This is what we very popularly call as the Havala transactions. You cannot enter into a financial transaction in India as consideration for acquisition of an asset outside India. Straight away come to this diagram, guys. In one explanation, you will understand. Imagine a situation, okay? There are 4 people in the story. In the story, red and blue, these 2 people are in India, okay, and green and yellow, these 2 people are in Dubai, okay. Red and yellow, both of these people belong to the same organization, or let's say they are friends. All right, so I want a property in Dubai. That is my objective. I am in India, I am blue, I want a property in Dubai, but I am in India. Now I don't want to send foreign currency and all to Dubai for this property. I don't want to do that. I'm trying to find a shortcut. What I'm doing is, I'm going to this person, Mr. Red. I'm telling him, listen, I'll give you 1 lakh rupees. In return, you ask your Dubai friend, you ask Mr. Yellow, your Dubai friend, ask him to give property to my brother in Dubai. So I am in India. Red is also in India. Red's friend is in Dubai, and my brother is also in Dubai. My objective is what? What am I looking at? I am looking at a property in Dubai. I want that property. I don't mind taking that property in my brother's name, but I want that property. So what I'm doing is, I am giving money to the Indian dealer. I'm giving money to Red over here, and I'm telling Red, see, this side in India I am giving you money. Other side in Dubai, my brother should get the property. Getting it, guys? So in an ideal situation, what we should have done? In an ideal situation, I should have directly sent the money to Dubai, guys. That is what I should have done. I should have, through an authorized dealer, through an authorized person, I should have properly, through, using the FEMA rules and regulations as per RBI provisions, I should have directly sent the money to Dubai, but I'm not doing that. This is a Havala transaction where I am entering into a financial transaction in India. In India, I am giving 1 lakh rupees. So I'm saying one side in India, I will give you 1 lakh rupees. On the other side in Dubai, my brother should get the property. Getting it, guys? So I'm entering into a financial transaction in India as a consideration for acquisition of asset outside India. This is Havala transaction. All of these are not allowed. So section 3 says that no person shall deal in or transfer Forex or Forse to any person who is not authorized person. No person shall make payment to a PROI. No person shall make payment for the credit of PROI. Then no person shall receive payment from PROI otherwise than through authorized person. And lastly, no entering into Havala transactions. If you want to enter into any of these transactions, you should do the transaction as provided in the Act. In the FEMA itself, in multiple places, provisions, rules and regulations have been given that how you should enter into these kind of transactions. So follow those procedures and enter into transactions as per FEMA. Alright, or get general or special permission from RBI. If you specifically want to do any of these transactions, get permission from RBI and then do the transaction, or do the transaction as per the provisions given in FEMA. But directly, just like that, you can't buy or sell dollars to your neighbor. You can't simply accept payment in dollars in your restaurant from a customer. These these kind of transactions you can't do on your own. So these kind of transactions can be done only if provided in the act or with the general or special permission of RBI. Okay, so this was your first discussion after the residential status discussion. Now come to the next point over here, holding of foreign exchange. PRI, person resident in India. This concept is only for PRI. He shall not adopt, he shall not acquire, hold, own, possess or transfer Forex, for sale or immovable property outside India. For these kind of transactions, separate notifications have been issued. Separate terms and conditions have been given. Subject to those terms and conditions only, you can do these transactions. But otherwise, just like that, you can't do these transactions. There is basic logic behind this, guys. I'll tell you. See, FEMA does not want persons resident in India to freely stash all the money abroad. FEMA does not want PRIs to send all the money outside India, use the money to buy properties in Dubai, use the money to buy shares of Apple. See, you can do all this only with RBI's permission. You can do all this only subject to terms and conditions. So follow the notifications, comply with the terms and conditions, and then only you can do all this. But freely, you can't do all this. Okay, what you can't do? You can't A for acquire, H for hold, O for own, P for possess, T for transfer. You can't do adopt. A for acquire, H for hold, O for own, P for possess, T for transfer. You can't acquire, hold, own, possess, transfer. What? Forex, for say, immovable property. But you can do all this only if you comply with the separate notifications which have been issued in this regard. Follow the terms and conditions. Following the procedures, you can do all this, but otherwise freely you can't do this. Alright, guys, and then coming to another concept over here, transfer. Transfer includes glimpse. G for gift, L for loan, E for exchange, M for mortgage, P for pledge, P for purchase, and S for sale. So for the purpose of FEMA, the definition of transfer is given to you. It's an extensive definition. It starts with the word includes. So transfer includes gift, loan, exchange, mortgage, pledge, purchase, sale. G for gift, L for loan, E for exchange, M for mortgage. Then we have two P's. One P for pledge, another P for purchase, and then sale. So transfer includes all of these for the purpose of FEMA. Okay, now come on, guys. So the first most important discussion we had today was Forex and for sale. Second really important discussion was residential status. Now comes the third really important discussion, current account transactions and capital account transactions. We'll discuss both of them one by one. In the last 2-3 concepts, I went a little quick because not too much for me to explain. It's more for you to sit and study. But again, current account transactions and capital account transactions, again we will slow down a little bit, guys, and we will try to do them as in depth as possible. Two things you have to study now, current account transactions and capital account transactions. Now before we go in depth, guys, two small generic things I want to discuss with you. Thing number one, see, when it comes to current account transactions, generally they affect your P&L account, but not always. There may be exceptions. Similarly, capital accounts generally will affect your balance sheet, but not necessarily. There can be exceptions. So in a general situation, current account transactions are your P&L items and capital account transactions are your balance sheet items. Okay, one more generic point. Okay, generally if you see current account transactions, they are permitted, freely permitted. You can do the transactions freely permitted unless specifically prohibited. Similarly, capital account transactions, if you see, generally they are prohibited unless specifically permitted. Let me try to simplify this for you. Let's create a small table over here. Current account transaction and capital account transaction. Okay, tell me, current account transaction will generally impact your P&L, guys. They are your P&L items, and capital account transaction are generally your balance sheet transactions. Then generally current account transactions you can do or you cannot do. Generally current account transactions you are permitted to do, you are allowed to do. Capital account transactions generally you are prohibited to do, you can't do them, you can't do those transactions. So current account transactions are generally permitted unless specifically prohibited. Capital account transactions are generally prohibited unless specifically permitted, which means generally you can do current account transactions, you're permitted to do. If the government does not want you to do a particular current account transaction, the government will specifically mention. Similarly, capital account transactions generally are prohibited, you can't do, but if the government wants to let you do a capital account transaction, the government will specifically mention, the law will specifically mention. Understanding? So current account transactions are generally permitted unless specifically prohibited. Capital account transactions are generally prohibited unless specifically permitted. permitted. Understanding? Now come on guys, let's go all in our current account discussion. Now we'll first start with the definition. We'll understand the definition properly. We'll learn up the definition. We'll go inside the schedules. Our full focus now is going to be on the current account transactions. Let's do this as nicely as we can. Now when you come to the definition of current account transaction, this is a definition guys. The definition has two parts again, same like how we had in Forex and in Forse. Even there we had means and includes, even over here same thing guys. So first let's try to properly understand the definition. Current account transaction means what? It means any transaction other than capital account transaction. So simple. Current account transaction means any transaction other than a capital account transaction. Repeat again. Current account transaction means a transaction other than capital account transaction, and then it includes four things guys. You will enjoy this discussion. Listen to me. The 4 points over here are very interesting. It includes 4 transactions, which means can I say that these 4 are examples of current account transactions guys? Because includes, right? So we can't say current account transaction is only equal to these 4. No, these 4 are only examples of these 4 are only examples of current account transaction. Number 1, payment in the ordinary course of business. Payment in the ordinary course of business with respect to foreign trade and other current businesses, services, and short-term banking and credit facilities. Let's try to understand. You've made a payment. The payment is an ordinary course of business, which means a payment is a part of your day-to-day business guys, and that payment may relate to any of these 3 things. Like for example, let's say foreign trade and other current businesses. You're an Indian importer, let us say. You imported goods from US. Now you have to make the payment to that foreign seller. So you made a payment as a part of your day-to-day business in ordinary course of business relating to foreign trade. So this will become a current account transaction. Now, second example, you made payment for a service. Let's say you're an Indian company. Now you need a Microsoft license. So you made payment to Microsoft Corporation for a Microsoft license. So you made a payment in the ordinary course of business for a service, guys. Then comes the third point, short-term banking and credit facilities. Let's say you borrowed a loan, a short-term loan for the purpose of your business. Now for the short-term loan, you have to pay some interest. So you made payment of interest as a part of your day-to-day business relating to short-term banking and credit facilities. All of these will become current account transactions. Understanding guys? Now come to the second above over here. You made a payment relating to interest on loans or net income from investment. Interest on foreign loans guys. You made payment on interest on foreign loans. You borrowed a loan from a foreign country. You are making payment of interest. Even this will become a current account transaction. See, if you borrow a loan, the loan will become a capital account transaction because loan will affect your balance sheet. So loan will become a capital account transaction, but interest on the loan, that interest will go to the P&L. No. So therefore this will become a current account transaction. Understanding? Or let's say you received net income from investment. Let's say you bought shares of a foreign company and you're getting dividend income. So even that will become a current account transaction, net income from investments. Then comes your third dabba. You made a remittance. Remittance means what? You're sending money. You're sending money for living expense of your parents, spouse, or children living abroad. Let's say you're studying in the US in a university and your father is in India and your father is sending you money every month to help you with your living expenses. So from your father's point of view, he's making a remittance for living expenses of his son or daughter living abroad. So from your father's point of view, what he did over here, even this was a current account transaction, he's sending money for living expenses abroad of his parents, his spouse, or his children. Then comes a fourth point, expenses of foreign travel, education, and medical care. Like for example guys, let's say I'm making payment for some foreign travel. I'm buying some foreign tour package. That will become a current account transaction. Or I'm making payment of some education expense. Like let's say I'm paying tuition fees to a UK university. Or medical care expense. Let's say I'm paying hospital bill of some medical treatment I took abroad. So all of these will come under current account transactions guys. Please remember, once again I'm saying that this is not an exhaustive list. I am not saying that current account transaction is equal to 1, 2, 3, 4. No. These 4 are only examples of current account transactions guys. Following. So current account transaction means a transaction other than a capital account transaction, and it includes payments in the ordinary course of business with respect to 3 things: foreign trade and other current businesses, services, and then short-term banking and credit facilities. Then it also includes payments relating to interest on loans and net income from investments. Then it also includes remittances for living expenses abroad. Whose living expenses? Parents, spouse, and children. And lastly, expenses on 3 things: foreign travel, education, and medical care, of whom same 3 people guys. parents, spouse and children. So all of this will come under current account transaction. Extremely important concept. You can get a standalone 2 marks or a 3 marks question just asking you to define current account transaction. So you will write 2 parts in the definition: current account means and current account includes. Easy guys. Now listen, come to this part now. Central government in consultation with RBI, which means central government plus RBI together, they have given some restrictions on current account transactions. And where are those restrictions? You will find those restrictions in the Foreign Exchange Management Current Account Transactions Rules 2000. Once again, central government plus RBI, central government in consultation with RBI has given some restrictions on current account transactions. And where do you find those restrictions guys? In Foreign Exchange Management Current Account Transactions Rules 2000. You have to remember this, okay? Foreign Exchange Management Current Account Transactions Rules 2000. Repeat again, Foreign Exchange Management Current Account Transactions Rules 2000. FEMA 1999 came into force on 1st June 2000. Current account transactions restrictions, where will you find? Foreign Exchange Management Current Account Transactions Rules 2000. Okay, now inside these rules guys, there are 3 schedules: Schedule 1, Schedule 2 and Schedule 3. Okay, now Schedule 1 gives us a list of prohibited transactions, prohibited current account transactions, those transactions which are prohibited to do. Schedule 2 gives us a list of those current account transactions which are permitted to do. You can do them, but for them you require central government approval. And Schedule 3 gives us a list of those current account transactions which are permitted to do, but you require RBI approval. So very simple guys, we are talking about current account transactions now. These current account transactions, the restrictions are given where? In Foreign Exchange Management Current Account Transactions Rules 2000. In those rules, how many schedules you have? 3 schedules you have. In the first schedule you have prohibited current account transactions. In the second schedule you have permitted current account transactions but you require central government approval. And Schedule 3 we have permitted current account transactions which require RBI approval. Simple. So what do we have to do now? Just look at these 3 schedules one by one, but carefully we have to see these 3 schedules. See, do we have to mug up the schedules? No. Will they ask us write a list of the transactions in Schedule 1? They won't do that guys. But how we should understand, how we should learn this is that they'll give us a couple of transactions and we should be able to identify whether the transaction is falling in Schedule 1, Schedule 2 or Schedule 3. Understanding? So you don't have to mug up the list. You don't have to remember 1, 2, 3, 4, 5 like that. You don't have to learn the list as such, but you should have that much awareness that which transaction will go under which list. Easy only guys. So come on, let's enter into the discussion. Our first focus, our 100% attention now is going to be on just Schedule 1. Schedule 1 of what? Schedule 1 of Foreign Exchange Management Current Account Transactions Rules 2000. What does Schedule 1 contain? Schedule 1 contains some transactions: current account transactions, capital account transactions, current account transactions, prohibited transactions, permitted transactions, prohibited transactions. Now see, I'll come to the transactions. 1 minute wait, okay? But first let us understand what is prohibited in this. In these transactions, what is prohibited? Let us understand that first. Only then we will be able to get a better understanding. See guys, this one para over here is what I'm talking about right now. This para says that these transactions, which transactions? The Schedule 1 prohibited current account transactions, they are not illegal. These transactions can be carried on in Indian currency without any restriction. Also, inward remittance of Forex into India from these transactions is also permitted. Then where is the prohibition? It is a drawal of foreign exchange out of these transactions for remittance out of India that is prohibited. Come on, I'll help you understand. One simple example I'll give you, okay? The very first prohibited transaction is remittance out of lottery winnings. With this example, with this point, I'll explain the whole para to you. Remittance out of lottery winnings is a prohibited transaction in Schedule 1, okay? Now let us imagine one situation, okay? This side of the page is India and this side of the page is a US, let us say. So in India, we have a person, Mr. Blue, okay? Now this Mr. Blue, he participated in a lottery. And lucky winner, he won the lottery, so he got a big prize money, okay? Now, this prize money is in INR, guys. If he's going to send this INR itself to US, allowed, no problem. Now, second situation. In US, I have another person, Mr. Green. This person, Mr. Green, he won a lottery in the US. So, he won a prize in the US. And that prize in dollars, he is sending to his friend, Mr. Blue in India. So which means from India's point of view, there's an inward remittance, guys. Inward remittance of dollars. Even this is allowed, no problem. So in my first transaction, if you see, why did I say allowed? I said allowed because I'm doing an outward remittance, but outward remittance of INR only. No, I'm not taking foreign exchange out of India. I'm taking INR only out of India. allowed. In my second transaction, why did I say this was allowed? Because from India's point of view, think from India's point of view, is money going out of India? No, money is coming inside India. If money is coming inside India, no problem, allowed. Inward remittance is allowed. Then where is the prohibition? See, this person, Mr. Blue, in India, he won a lottery. He won a lottery prize. Now that prize is in rupees. He first converts that rupees into dollars, which means he buys dollars in India. And then that dollar he is sending to his friend Green outside India. This is what is prohibited. Why is this prohibited? Because see carefully. What is he doing? He is first drawing foreign exchange, guys. There is drawal of foreign exchange, and then there is outward remittance. This is what is prohibited. If it is outward remittance of INR, it is allowed. If it is inward remittance of foreign exchange, it is allowed. It is drawal of foreign exchange for outward remittance, that only is allowed. So in all of these transactions, this point is going to be common, guys. What is the common point? That if you're going to receive money in India, welcome. If you're going to send INR out of India, allowed. Where is the problem? Where is the prohibition? If you're going to send dollars out of India, if you're going to draw foreign exchange in India and then send it outside India, that is where the whole prohibition is. Understanding, everybody? It is drawal of foreign exchange for outward remittance. This is what the prohibition is. Okay, so in my first point over here, remittance out of lottery winnings, understood? You won a lottery in India. That lottery gave you a prize. Now that prize money you're converting into dollars. The dollars you want to send outside India, not allowed. So when I say prohibited, what is prohibited, guys? Outward remittance of dollars of foreign exchange, that only will be prohibited over here. Outward remittance of INR, no problem. Inward remittance of foreign exchange, no problem. It is outward remittance of foreign exchange that is prohibited over here. First transaction, guys. Then comes second transaction, remittance of income from racing, riding, etc. Same thing. So if you have some income in India from racing or riding, that income if you convert into dollars, and the dollars if you want to send outside India, prohibited, not allowed. Outward remittance of foreign exchange, not allowed. Then comes the third transaction. If you are sending money from India for purchase of lottery tickets, or for purchase of banned or prescribed magazines, or for football pools. Football pools are nothing but betting or gambling with respect to football matches, or sweepstakes, which is nothing but betting or gambling with respect to horse races. So if you're going to send dollars from India for these purposes, again it becomes a prohibited transaction, not allowed. Okay, giving you a reminder once again, these are transactions, current account transactions. These are prohibited current account transactions. Where are they mentioned? In Schedule 1. Schedule 1 of Foreign Exchange Management, Current Account Transactions Rules 2000. These are prohibited transactions. Doesn't mean they are illegal transactions. Only outward remittance of foreign exchange from these transactions, that only is prohibited. Okay. Now see, we have 5 more Schedule 1 transactions. But these 3, guys, the next 3, they are very interesting points. So I've brought them over here. We'll see them one by one in detail. Okay. The first one says payment of commission on exports made towards equity investments in joint ventures or wholly owned subsidiaries abroad of Indian companies. Now listen, I will not go too much in detail because it's more of a revision session, but still I want to give you an idea, a brief idea at least, about these transactions, because what I've seen is students literally try to mug this up. Okay, so that is why I want to give you an overview. Listen to this entire discussion. You will find it really interesting. I can challenge you. See, imagine a situation like this. There is an Indian company over here, Reliance Industries Limited, an Indian company. Now this Indian company is exporting goods to New York. Good, guys, export goods. Now just exporting goods is not enough. These goods also have to be sold in New York. So what Reliance did is it appointed agents in New York to sell the goods in New York. Okay, now through the agents, good sale happened, guys. Good revenue was generated in the US. In dollars, good revenue was generated. In an ideal situation, what will Reliance do? In an ideal situation, after exporting these goods, after earning these dollars, Reliance will repatriate these dollars back to India. That is why we encourage exports, guys, because as we export goods more and more to the US, more and more dollars will flow into our country. That is the whole point of exports. That is the whole reason why we encourage exports, for this dollars inflow in India. But however, Reliance is not bringing this money back to India. They are not repatriating the money back to India. Instead, guys, let us say Reliance has a wholly owned subsidiary outside India. Let us say Reliance has a joint venture outside India. That a dollar revenue which they have earned outside India from this export, no, from this sale, that dollar revenue, they are investing in this foreign wholly owned subsidiary. They're investing this dollar revenue in their foreign joint venture. They're not bringing this money back to India. They are reinvesting the dollars which they have earned outside India in an in a wholly owned subsidiary or in a joint venture outside India. So tell me now, was this export good for the country? No, guys. Export is good for the country only when dollars are repatriated back to India. Dollars are not repatriated back to India. So this export was not good for the country. Alright, till here understood the story. Now agents, their demand is coming. They are saying that we sold your goods in New York. No, give us commission. Of course, Reliance has to give commission to these agents. Now, listen, Reliance, to give commission to these agents, you can use rupees, you can use INR, no problem. But, however, drawal of foreign exchange for outward remittance of commission to this agent will be prohibited. You understood what is a prohibition over here? So the whole prohibition over here is payment of commission on exports. Which exports? Those exports which are then converted into equity investment in joint ventures or wholly owned subsidiaries abroad of Indian companies. Payment of this commission in foreign exchange, that is prohibited. You know very well, in all of these prohibited transactions, the transaction is not prohibited. Making payment in INR is not prohibited. Inward remittance is not prohibited. What is prohibited? Outward remittance of foreign currency. This is what is prohibited. So if you're going to pay dollars to this agent, this outward remittance will become a prohibited transaction. Understanding, everybody? This was payment of commission on exports made towards equity investment in joint ventures or wholly owned subsidiaries abroad of Indian companies. Okay, now come to the second transaction over here. It says remittance of dividend by any company to which the requirement of dividend balancing is applicable. Now, dividend balancing is more or less an outdated concept, okay? But I'll still try to explain to you what exactly happened over here. Imagine there are two companies, Happiness Limited and Peace Inc. Now, Happiness Limited is an Indian company and Peace Inc. is a US company, let us say. Now, this Peace Inc. happens to be a shareholder of Happiness Limited. So, and hence, Happiness Limited has to pay dividend to Peace Inc. Now, come to the second part of my story. This Happiness Limited has earned income from Australia also. It has earned income from India also. So, it has earned income from outside India. How much? From Australia, it has earned $500,000. Now, it has earned from Australia $500,000, from India $200,000. Now, the whole question is, can this Indian company give the entire $700,000? Can they give the entire amount to the foreign shareholder as dividend? The answer is no. This is where the prohibition comes into the picture. The Schedule 1, the current account transaction Schedule 1, the prohibition says, see, whatever money you have earned from outside India, that you can give as dividend, no problem. But whatever you have earned from India, to this extent, you can't give dividend outside India. So, you are prohibited to pay dividend to the foreign shareholder to the extent of the revenue which you have earned in India. Whatever revenue you have earned outside India, to that extent, you can pay dividend to your foreign shareholder. So basically, simple logic, guys, you've earned money from outside India and that money you are sending as dividend outside India, permitted. But whatever revenue you are earning in India, whatever income you are earning in India, that you can't send as dividend outside India. This is called as dividend balancing. So you are prohibited to send whatever money you have earned in India outside India as dividend. Okay. Then comes the next point over here, payment of commission on export under the rupee state credit route. Payment of commission on export on rupee state credit route. Again, a very, very interesting situation. I'll tell you what exactly happened over here. You have to first understand the rupee state credit route, only then we will come to the prohibition. Alright, listen to me. See, look at this, okay. 1 second. Yeah, look at this one. Let's say on one side we have the Indian government, and the Indian government has purchased outdated military equipment from the Russian government. Okay. Now, when the Indian government had to make payment for these outdated military equipments to Russia, they made payment in rupees, in Indian rupee. Russian government accepted because India was anyways doing a big favor on the Russian government because we were ready to purchase their outdated military equipment. So even though we were giving them consideration in rupees, they accepted it. Okay. Now, which means Russian government has a lot of rupees. They have a lot of Indian rupees. Now, what are they going to do with this Indian rupees? Whenever Russia imports goods from India, whenever India exports goods to Russia, or other way around, if you see, whenever Russia imports goods from India, when Russia has to make payment to India using that Indian rupee, they will make payment to India. Okay, guys. So, two transactions. Transaction number 1, Indian government has purchased outdated military equipment from the Russian government and in return has paid consideration in INR. Now, whenever Russia imports goods from India, when they have to make payment for those goods to India, they make payment in Indian rupee. Okay. Now, tell me, was this export beneficial for our country? India is exporting goods to Russia. Is this export beneficial for our country? No, guys, because in return is dollars flowing into the country. In return is foreign exchange flowing into the country. No, in return, Indian rupee only is flowing into the country. So this export was not majorly beneficial for us. Now, to sell these exported goods in Russia, I appointed an agent, guys. To this agent, I have to give commission. If I pay this commission in INR, in Indian rupee, it will be allowed. But if I pay commission to this agent in dollars in foreign exchange, this is going to be prohibited. Understanding why am I prohibiting this? Because see, with respect to this transaction, did any foreign exchange flow in? No. If no foreign exchange came in, I will not let foreign exchange go out also. I will not let you pay to the agent commission in foreign exchange. It will be prohibited because no foreign exchange came in from Russia. So when you have to pay a commission to the Russian agent using foreign exchange to pay that Russian agent, we will not allow. It will be prohibited. Understanding? So this is your rupee state credit route. Payment of commission on exports. This whole thing is called as rupee state credit route. Paying commission on exports under rupee state credit route is a prohibited transaction. Again, I'll tell you, I'll give you a reminder once again. These are not illegal transactions. For these transactions, using dollars, using foreign exchange of any form, using foreign currency in any form to make payment for these transactions, that is prohibited. Outward remittance of foreign exchange is prohibited. If you're going to pay this commission to this Russian agent in INR, in Indian rupee, you're welcome to do it. But however, if you're going to pay commission to this Russian agent in foreign exchange, that is, if there's going to be an outflow of foreign exchange from our country for paying commission on exports under rupee state credit route, it will be prohibited. However, there is an exception. In the exception, there are two conditions. Condition number one, you are paying commission not more than 10% of the invoice value. Condition number one. Condition number two, the goods are tea and tobacco. Condition number two. If both of these conditions are fulfilled, then in that case, if you're going to use dollars, if you're going to use foreign exchange to pay commission for export under rupee state credit route, it will be allowed. So exception, two conditions. Condition one, commission is within 10%, and condition number two, goods are tea and tobacco. For this commission, even if you're going to use foreign exchange to pay commission to the agent, it is going to be allowed, not a problem. Okay, so with this, guys, coming back to my schedule 1, what are the points we have learned already? Number 1, remittance out of lottery winnings, drawing foreign exchange for this transaction is not allowed. Then remittance of income from racing and riding, remittance for purchase of lottery tickets, banned or prescribed magazines, football pools and sweepstakes. Then we spoke about payment of commission on exports made towards equity investment in your joint ventures and wholly subsidiaries abroad of Indian companies. The Reliance Industries Limited example. Then remittance of dividend under dividend balancing, that Happiness Limited and Peace Inc. example. Then payment of commission on exports under rupee state credit route, nothing but your Russia outdated military equipment example. Okay. Now come, we have the last two prohibitions, the last 2 points under your Schedule 1 current account transactions. So guys, the first transaction over here is callback services. Now today callback service has become outdated again, because today if I want to make an international call, I will simply call on WhatsApp, guys. It's much cheaper. But earlier, when we did not have WhatsApp and all, whenever we had to make an international call, it used to be very expensive. Like for example, let us say I am in India and you are in the US, okay, and I want to call you. If I directly call you, international outgoing call for me, very expensive for me in India. So therefore, in US, we started having these callback service providers. They were entities in US providing something called as callback service. Now this callback service provider is in the US. Okay, so what used to happen is I'll give a call to this callback service provider. Missed call I will give. Okay, this callback service provider will then call me back. He will be online and I will dial your number. So like how today you do conference calls, no, something like that. So he will call me. Once he calls me, I will dial your number, and that is how I will talk to you. So for providing the service to me, the callback service provider would charge a very small amount from me. Okay, you're understanding, right, why people started doing this? Because if we directly make an outgoing call, extremely expensive. So instead, in this situation now, I'm not having an outgoing call, I'm only having an incoming international call, and incoming international calls are not very expensive. So that is why through this route, people started making foreign calls quite a lot. And the callback service provider used to charge one small amount for the service. Okay, so little money, a lot of money started going to the callback service providers in US in dollars. The government did not like that, so the government put this in the prohibited current account transaction. I am prohibited from sending dollars to callback service providers. Okay guys, it's a prohibited current account transaction. Outward remittance of dollars to make payment to callback service providers is prohibited. Now comes my last point, remittance of interest income on funds held in NRSR account, non-resident special rupee account, which we very popularly call as the NRSR account. I'll help you understand what is this NRSR account first of all. See, imagine there's a non-resident, okay. Now you must have seen, even in your family, you might be having cousins and all who are settled outside India, but they still have some houses in India, they still have some shares in India, and they also have some expenses in India also. So even though they are living outside India now, they still have some transactions over here. So look at this NRSR account like a piggy bank of that non-resident. Now in this piggy bank, only INR, only rupees only will come in. Okay, so this non-resident is having some house property in India from which he's earning rent in INR. That INR, that Indian rupee rental income will get credited in this account. Then let us say he's also having shares of some Indian company from which he's getting dividend in rupees. Even that rupees, even the dividend income will get credited over here. So all his INR, all his Indian rupee transactions, all his Indian rupee incomes will get credited over here. Similarly, he'll have some Indian rupee expenses, like he has to pay, let's say, life insurance premium, or let's say for this house he has to pay municipal tax. So he'll also have some Indian rupee expenses. Using the money in this piggy bank, he will make the payment of those expenses also. So basically, in this NRSR account, the money will be in INR. Inflows in INR and outflows in INR will happen from this account. But end of the day, guys, this is a bank account only. So because it's a bank account, bank interest will accrue over here. Now whatever interest accrues over here, can you send this interest income outside India in foreign exchange? Not allowed. Understanding? This interest income can stay in India. You can use the interest income in India, but can you draw foreign exchange to remit this interest income outside India? That is not allowed. Okay, so guys, over here we had all these transactions. They're all current account transactions, but they're not illegal transactions. Only using foreign exchange, only outward remittance of foreign exchange from these transactions is prohibited. Okay, so number one, we had a remittance out of lottery winnings. Let's say you come to India, you won a lottery and you want to take that money out of India, not allowed. Similarly, you come to India, you won some money out of racing or riding and you want to take that money out of India, not allowed. Similarly, you're taking money from India because you want to purchase lottery tickets outside India, or you want to purchase magazines outside India, or football pools or sweepstakes outside India, not allowed. Similarly, if you want to make payment of commission on exports towards equity investment in joint ventures or wholly owned subsidiaries abroad of Indian companies, remember the Reliance Industries Limited example, guys, not allowed, prohibited transaction. Then remittance of dividend under dividend balancing, remember Happiness Limited and P-Sync, again this is going to become a prohibited transaction. Then payment of commission on exports under the rupee state credit route, you will never forget the Russian example, guys. So any payment of commission on export under rupee state credit route, prohibited, not allowed. If you want to do all of these transactions, for these transactions if you want to draw foreign exchange and take out of India, prohibited. Then we have payment related to callback services or telephone, prohibited transaction. And lastly, remittance of interest income, guys, interest income under NRSR account. From the NRSR account, whatever interest income you have earned, you can't take that money out of India. Any outward remittance of foreign exchange from any of these transactions is prohibited. It is not allowed. Now, where is it prohibited? Where is all this written? In Schedule 1. Schedule 1 of what? Schedule 1 of Foreign Exchange Management Current Account Transactions Rules 2000. Who has given these rules? Who has given all these restrictions? Central government has given these restrictions in consultation with RBI. Can you write just RBI? No, guys, it will be wrong because RBI does not have the power to give these restrictions. These restrictions are given by central government in consultation with RBI. Okay, guys, so with this, can I say that you're really thorough with Schedule 1 of Foreign Exchange Management Current Account Transactions Rules 2000? Yes, guys. So with this, we will close this session over here. In our next session, we will take up Schedule 2, Schedule 3 and Capital Account Transactions. All of the remaining part we will finish off in our next session. Thank you, guys. I'll see you in the next session. Bye-bye. Hello champions. So continuing with the discussion on FEMA, we're doing the concept revision first. In the concept revision, until now, we're done with current account transactions till Schedule 1. We know that with respect to current account transactions, central government in consultation with RBI has given Foreign Exchange Management Current Account Transactions Rules 2000. Now in that, Schedule 1 is about prohibited transactions, transactions for which outward remittance of foreign exchange is prohibited. We've already completed this. Now come on, our entire focus is going to be on Schedule 2 and Schedule 3. In Schedule 2 and in Schedule 3, in both, we have permitted current account transactions. Both we have permitted current account transactions, but however approval is required. In Schedule 2 transactions, we require central government approval. Concerned Ministry of Central Government's approval is required. In Schedule 3, we require RBI's approval. So come on everybody, let's have a look at the Schedule 2 transactions one by one. Number one, we have over here cultural tours. Like for example, let's say you want to draw foreign exchange to conduct a cultural tour outside India. Like for example, an album release, or let's say movie screening, or let's say music recitals or dance programs. If you want to conduct any of these outside India, and for that if you want to draw foreign exchange, you can draw, but for that you require the approval of Ministry of Human Resources and Development, which is now called as the Ministry of Education. Okay, then after this comes the second point. If you want to remit prize money or sponsorship of sports activity abroad more than $1 lakh, see, I'll explain this to you straight away over here. Okay, come to this point. Straight away look at these examples, you will understand. See, let's say we have TCS Limited, an Indian company. Now this company is organizing one sports event outside India. Okay, now whoever is a winner of the sports event, to the winner TCS Limited has to give prize money. money. So if they have to give prize money more than $100,000, so if they have to draw foreign exchange more than $100,000 to pay prize money to the winner of a sports event outside India, for this remittance they require central government approval. Okay guys, but instead of TCS Limited, if the person conducting the sports activity, if it happens to be an international, national or a state level sports body, like for example BCCI guys, then for BCCI any central government approval will not be required. Understanding? Now come back to my point. The situation says over here, remittance of prize money or sponsorship relating to what? Sports activity. How much do you want to remit? More than $100,000 you want to remit, then you require the approval of Ministry of Human Resource Development, which is now called as Ministry of Youth Affairs and Sports. Okay, now but then however, if the person who's remitting the money happens to be an international, national or state level sports body, for them no approval is required. Understanding guys? So in my first point, cultural tours. Second point, remittance of prize money or sponsorship more than $100,000 relating to what? Sports activity. But you don't require any central government approval if you are a national or international or a states level sports body, then for you approval is not required. Okay, all of these are current account transactions. All of these are permitted current account transactions, just that you require the permission of central government approval for the remittance. Okay, now come to the third point. See guys, the second point and the third point both are very important. Second point was relating to sports activity, you've understood it properly. Now come to this third point relating to foreign print media. Even for this I will straight away discuss it with you over here. See guys, it's actually one small paragraph over here, okay, but it has so many small points involved, and in the examination we have to check all these points. Only on that basis we are allowed to give an answer. So that is why instead of learning it as a para and remembering some points and not remembering some points, instead of leaving a scope of mistake over here, I want you to straight away try to learn this in the form of these 5 conditions. I've put 5 conditions over here guys. Only if all these 5 conditions are fulfilled, only then you will say central government approval is required. Okay, condition number 1, who are you? You happen to be a state government, or you happen to be state government's public sector undertaking, PSU, but you're not central government's PSU. Either you are state government or you're state government's PSU. Condition number 1. Condition number 2, how much money are you taking from India? What is the outward remittance of foreign exchange? The outward remittance of foreign exchange is more than $10,000. Be careful, for this sports activity the outward remittance was $100,000, and for this this activity now which I'm discussing with you, here the remittance is more than $10,000. So condition number 1, who are you? State government or state government's PSU. Condition number 2, how much is the outward remittance over here? More than $10,000. This remittance is for what? This remittance is for advertisement expense. Basically, you want to give an advertisement outside India. Now, where do you want to give this advertisement? In a foreign print media, which means either in a foreign newspaper or in a foreign magazine. In foreign print media, not radio advertisement. It is not TV advertisement. It is in print. So newspapers, magazines and all. Okay. And why? What is this advertisement for? This advertisement is not for tourism. It is not relating to foreign investment. It is not relating to international bidding. It is for any other purpose only. If all these conditions are fulfilled, guys, then for this foreign exchange drawal, you require the approval of central government. Understanding? Come on, once again, what are the 5 conditions? Condition number 1, you are making a drawal of foreign exchange. You're doing an outward remittance of foreign exchange for advertisement expense. Advertisement in a foreign print media. Who are you? State government or state government's PSU. How much is the outward remittance? More than $10,000, and the advertisement is not relating to tourism, foreign investment or international bidding. It is for any other purpose only. If all these conditions are fulfilled, then central government approval will be required. Understanding guys? So my first point was about cultural tour. Second point was remitting prize money more than $100,000 outside India for a sports activity. But in the second point, remember, approval is not required if you are a national, international or a state level sports body. Then in the third point, you are making a drawal of foreign exchange. How much? More than $10,000. Who are you? Either you are the state government or your state government's PSU, and this remittance is relating to what? Advertisement. Advertisement in what? Advertisement in a foreign print media. And what is the purpose of the advertisement? The purpose of the advertisement is not tourism, foreign investment or international bidding. So 5 conditions. If all these 5 conditions are fulfilled, then you need the permission of Ministry of Finance, Department of Economic Affairs. Okay. Now come to the 4th transaction under the schedule 2. Right now we are learning current account transactions. Those current account transactions for which I require central government approval. In these current account transactions, outward remittance of foreign exchange is permitted, just that we require central government approval. Okay. Now come to the 4th point. This is very simple guys. Remittance for membership of P&I club. P&I is nothing but Protection and Indemnity Club. See, this is something which is again outdated. Earlier we did not have maritime insurance. Maritime insurance, which is for ship owners guys. Earlier we did not have this. So when maritime insurance was not existing, that is when the ship owners had created something for themselves called the Protection and Indemnity Club. So if you're a ship owner and if you're a member of this club and if you have to pay membership fees to this club, for that, if you want to make an outward remittance of foreign exchange, you require the consent, you require the approval of Ministry of Finance Insurance Division. Okay, so remittance for membership fees of Protection and Indemnity Club. Now come on guys, come to point number 5 and 6. So 5 and 6, I think I'll remove this and I'll discuss it with you. I'll draw it for you over here. What I'll do is I'll combine 5 and 6 and we learn them together. I think it'll give us a little better clarity. Imagine a situation where we have PSU on one side and we have Mr. Blue on the other side. This Mr. Blue is a Russian guy, let us say. He is a foreigner and this PSU is importing goods into India from this foreigner. Okay, so and these goods are coming by ship, guys. They're coming by sea. So do you agree that there are two transactions over here? Transaction number 1, this PSU has to make payment for the export, right? Payment has to be made for the import, that is for the goods that the PSU is importing. The PSU has to make payment to Mr. Blue. And secondly, the PSU also has to make payment for the freight charges. Because these goods are coming by way of ship, right? So the PSU has to pay the shipping agency also. So there are two payments over here. Number 1, PSU has to make payment for the import of the goods, and number 2, PSU has to make payment for these freight charges. Now for both of these transactions, for payment of freight also, for payment of the import also, for both we require the permission of Ministry of Surface Transport. If you want to draw foreign exchange, if you want to remit foreign exchange from India for these purposes, either you want to pay freight or you want to pay for the import, then, and if you're a PSU, you require the approval of Ministry of Surface Transport. You require central government approval. Okay, but however, when you're making payment for import, here you will require central government approval only if you're making the payment on CIF basis, which means cost, insurance and freight. It should not be FOB, it should not be FAS, it should not be free on board, it should not be free alongside ship. It has to be payment on CIF basis, cost, insurance, freight. Only then you require the permission of central government, that is Ministry of Surface Transport. Understanding? Two transactions I'm covering over here. Number 1, you're a PSU and you're importing goods by way of ship. So you have to make payment of freight to the shipper. So that freight, if you want to make an outward remittance of foreign exchange, you require central government approval. Then number 2, you're a PSU. You're importing goods from a foreign country. So you have to make payment for the import. You have to pay the foreign supplier. So when you're paying the foreign supplier on CIF basis, if you're making the payment, for that also you require central government approval. Okay, then comes your 7th point over here, remittance of container detention charges more than the rate prescribed by the Director General of Shipping. If you're making payment of container detention charges more than the rate prescribed, again you require the consent of Ministry of Surface Transport. Then comes point number 8, multimodal transport operators making remittance to their agents. I'll help you understand this. Okay, come to this. What do you mean by multimodal transport operator? First of all, understand that. Let's say I am in Chennai and I want to send goods to you. You're in California. So now, from Chennai to California, if goods have to be transported from Chennai to Mumbai, they'll go by train. From Mumbai to New York, they will go by ship. From New York to California, they'll go by road. Imaginary situation, guys, I'm creating over here. So I want to send goods to you in California. This is how the transportation will happen. Now, I don't have the bandwidth to sit and coordinate with each person over here. So what I will do is I will simply go to a multimodal transport operator. There are multiple such operators, guys. Like for example, you have DHL, you have Blue Dart, you also have FedEx. So all of these are multimodal transport operators. I will simply go and make payment to this person. I will ask this person, you arrange the whole transportation. Now this multimodal transport operator will have multiple agents. He'll have one agent over here handling this Chennai to Mumbai transportation. He'll have another agent over here handling Mumbai to New York transportation. He'll have another agent over here handling New York to California transportation. So this Blue Dart now will make payment to multiple agents. So when they are making payment to these multiple agents, when they are paying commission to these agents, that commission, if you want to do an outward remittance in foreign exchange, for that central government approval is required. Understanding? So if the multimodal transport operator is making payment to his agent, for that if you want to do an outward remittance of foreign exchange, you require the permission of Director General of Shipping. You require a registration certificate from the Director General of Shipping. Understanding? See, if I have to make payment to multimodal transport operator, that is not getting covered over here. The multimodal multimodal transport operator Blue Dart. Blue Dart will have to make payment to all of its agents. For those payments only, we require central government approval. Okay. Then we have the last point in this schedule 2, guys, remittance of hiring transponders. Now this is again a very important point. I have marked 3 important points for you. One was a prize money point, sports activity. Second was foreign print media. And the third, the last one is transponders. If you're making remittance for hiring transponders by TV channels and internet service provider, who are you? Either you're a TV channel or you're an internet service provider. You're taking on hire a transponder. For this, if you have to make the payment of hire charges, if you're making the payment of hire charges in dollars, in foreign currency, you require the permission of Ministry of Information and Broadcasting. If you're a TV channel, and if you're an internet service provider, you require the permission of Ministry of Communication and Information Technology. Okay, so these are 9 points in schedule 2. These are all current account transactions. For all of these current account transactions, drawal of foreign exchange is allowed. For all of these current account transactions, outward remittance of foreign exchange is allowed. Only thing is, we require the approval of central government's concerned ministry approval we require. Okay guys, I hope you understood. Number 1 was cultural tours. Then we had remittance of prize money relating to sports activity more than $100,000. See, we have amount only in 2 places over here. Number 1, we have this $100,000 amount over here for the sports activity, and number 2, we have this $10,000 amount over here for advertisement in foreign print media. Only 2 numbers, guys, not a big burden. Here you can't make a mistake. Okay, be careful. Then we had advertisement in foreign print media by state government or state government's PSU, more than $10,000, but not for tourism, foreign investment and international bidding. Then paying membership fees to P&I club. Then payment of freight by PSU. Payment for the import by PSU on CIF basis. Then container detention charges. Multimodal transport operators making payment to their agents. And lastly, making payments for hiring transponders. So all of these are current account transactions given in schedule 2. So with this, I can say that we are thorough with schedule 2 as well, wherever we require central government approval, guys. Now come on, let's shift our focus on schedule 3. What are we learning? Current account transactions. We're learning foreign exchange management, current account transactions rules 2000. All these restrictions have been put by central government. Central government in consultation with RBI. Not just RBI, central government. Central government has put these restrictions in consultation with RBI. In schedule 1, we had prohibited transactions. In schedule 2 and in schedule 3, both we have permitted transactions. Just that in schedule 2, I require central government's approval. In schedule 3, I require RBI's approval. Now come on guys, let's go to schedule 3. Schedule 3 is small. Schedule 3 is those current account transactions for which outward remittance of foreign exchange is permitted, but permitted with prior RBI approval. You require RBI approval. Now schedule 3, we will learn in 2 parts, guys. In the first part, we will learn about just individuals, and then in the second part, we will be learning part 2, we will be learning about the non-individuals. So we will learn this in 2 parts. Let's focus on just the individuals part now. So number 1, we have private visits over here. Private visits are nothing but, let's say I'm going on a vacation. I'm going on a vacation to Vietnam, or let's say I'm going on a vacation to Australia. So generally, whenever we go on a vacation to another country, we take some foreign exchange and we go with ourselves. We take some foreign exchange, guys. So for that drawal of foreign exchange, we require RBI approval. However, if I'm going on a vacation to Nepal and Bhutan, in these 2 countries, guys, Indian currency itself is accepted. So if Indian currency itself is accepted, why do you need foreign exchange then? So if I'm going to these 2 countries, for these 2 countries, if I take foreign exchange and go, it is prohibited. Drawal of foreign exchange to travel to Nepal and Bhutan is prohibited because in these 2 countries, Indian currency itself is accepted. So you don't need foreign currency. Then comes point number 2, gift or donation. So if I want to gift in dollars to my friend outside India, or if I want to make a donation to a foreign charity, whatever drawal of foreign exchange I do for these purposes, again I require RBI approval. Then going abroad for employment and emigration, same point only, guys. Emigration is nothing but you're leaving India, you want to permanently settle outside India. Like for example, let's say you got a job offer in Canada. So you're leaving India, you're taking all your belongings along with your family, you're going to go and settle down in Canada. Now in such cases, guys, the Canada government will put a condition on you that when you're coming to Canada, if you want to settle down over here, you have to bring some money along with you, because they don't want you to come empty-handed and then become a burden on that government. So that is why you'll have to take some minimum amount and you'll have to go over there. So therefore, whatever drawal of foreign exchange you're making because you want to move countries, even for that you require RBI approval. Then maintenance of close relatives abroad. Like for example, let us say I have a younger brother who is living in the US and he's studying over there. And every month I am sending him money for his maintenance, for his living expenses. Even for that, I require RBI approval. Then travel. One more travel, guys. See here, this was private visit, which means I'm going on a vacation, I'm going on a holiday. But then this travel over here is travel for business purpose, or let's say I want to attend an international conference or some specialized training or for some medical purpose or for some checkup abroad, or I just want to accompany as an attendant along with the patient. So even for these purposes, if I want to draw foreign exchange, even here I require RBI approval. Then expenses in connection with medical treatment abroad. Let's say I need to incur expenses for hospitalization abroad, or let's say I need to incur expense for medical treatment abroad. For that also, whatever money I take and go, even for that, whatever foreign exchange I take and go, for that also I require RBI approval. In all of these cases, guys, if I'm making an outward remittance of foreign exchange, I need RBI approval. Understanding? See, understand this carefully, okay? Even over here, what happens is, like for example, let's say there's a person and this person is going to get some medical treatment done in Singapore. Now the Singapore hospital where he's going to get a medical treatment done, that Singapore hospital will send an estimate that this is how much money roughly you will require for the medical treatment. So that much money this person will want to take and go along with him as foreign exchange. So when he's drawing foreign exchange to go outside India for medical treatment, for that drawal also he will require RBI approval. Then if you're drawing money from India for studies abroad, like for example, let's say you got admission in Oxford University. Now you're taking money from India because you have to pay hostel charges over there, you have to pay tuition fees over there. So you're drawing foreign exchange and you're going to take foreign exchange from here for studies abroad. Even over here you require RBI approval and any other current account transaction. So guys, over here all of these transactions we're talking only from the individual's point of view. So if you are an individual and if you're drawing foreign exchange from India, if you're making an outward remittance of foreign exchange from India for any of these purposes, you require RBI approval. Now here, if you notice, emigration point, the medical treatment point and studies point, these 3 points I've put in a different color for a reason. The reason you will understand a little later when I discuss liberalized remittance scheme with you. So for now, I think we are clear with schedule 3 part 1, guys. Part 1, which is only for individuals. Now come to part 2. In schedule 3 part 2, I am talking about non-individuals, companies, firms, non-individuals. Okay. So, if you are a non-individual, okay, and if you do any of these 4 transactions, which I will be discussing with you now one by one, if you do any of these 4 transactions, for that, you will require prior RBI approval. Okay, now what are these 4 transactions? Let us see one by one. In the first transaction, you are making a remittance for donation. In the first transaction, who are you, by the way? A non-individual. What are you doing? Outward remittance of foreign exchange, which means from India, you're taking dollars and you're sending outside India. Why are you sending this money? What is this remittance for? Donation. How much is a donation? More than a limit. What is the limit? The limit over here is 1% of your Forex earnings in the 3 previous financial years or $5 million, whichever is lesser. So once again, who are you? Non-individual. What are you doing? You're making an outward remittance of foreign exchange. Why are you making an outward remittance of foreign exchange? Why are you sending dollars for what? Because you want to make a donation. How much donation are you making? More than a limit. What is the limit over here? The limit is last 3 years foreign exchange earnings or $5 million, whichever is lesser. So, in simple words, if a non-individual is making an outward remittance of foreign exchange to make a donation which is more than this limit, then RBI approval is required. But here the interesting part is, you're making donation for what? You're making a donation because you want to create a chair. I will explain to you. Other 2 points are self-explanatory, guys. Either you want to make a donation because you want to create a chair, or you're making a donation because you want to contribute to a fund which is promoted by an educational institute, or you want to make a contribution to a technical institution or a body or association which is in the same field as a donor company. Let me help you understand this. Till here you understood, right? Till here I'm saying that you are a non-individual. You're making an outward remittance of foreign exchange because you want to make a donation more than a certain limit. You will require RBI approval for this donation. If you do the donation up to the limit, then no RBI approval is required. If you make the donation more than the limit, then only RBI approval is required. And what is a limit? The limit is 1% of your foreign exchange earnings of the last 3 years or $5 million, whichever is lesser. Okay. Now come to this part, guys. Why are you making the donation? Let's go backwards. You are making a donation because you want to make a contribution to a technical institution which is in the same field as a donor company. Like for example, let us say ITC. ITC is making a donation to one institution. That institution is doing a lot of research on how to make paper in a more eco-friendly manner. So now that institution is doing research in paper. Now paper, ITC also deals in paper, guys. ITC makes your classmate notebooks and all. So the company is making a donation to an institution which is in the same field as a company. So that will get covered over here. This is your last point over here. Then come to the second point here. In the second point, the company is making donation to a fund which is promoted by educational institutes. A lot of this is very popular, guys, in foreign countries. Like for example, if you take Oxford University will promote multiple funds. So if you can make a donation to any of those funds, even that will get covered over here. Then comes the most interesting part for creating a chair. What does this chair mean? I'll help you understand this in very carefully. Very interesting concept. Okay, let us say in Oxford University there are multiple degrees, multiple courses, multiple subjects, multiple specializations. So Infosys decides to create a chair relating to artificial intelligence at Oxford University. Now, what does this mean? What do you mean by Infosys has created a chair? Creating a chair means Infosys is going to give money. It's going to give donation. With that donation, the Oxford University is going to fund that AI professor's salary, AI professor's research, AI professor's teaching. Basically, that whole subject, in our example, AI, artificial intelligence, the whole subject is being sponsored by Infosys. So this is called as creating a chair in a foreign university. So come on, once again, who are you? You're a non-individual. Why are you making the outward remittance of foreign exchange? Because you want to make a donation. How much donation are you making? More than the limit. What is the limit? The limit is 1% of your Forex earnings of the last 3 years or $5 million, whichever is lesser. Why are you making this donation? You're making this donation either to create a chair in a foreign institute, or you want to make a payment to a fund. You want to donate money to a fund which is promoted by an education institution, or you want to make donation to an institution which is doing research in the same field as a company. This is your first point, guys. So your first point is nothing but donation. You're making a donation more than a certain limit. For that donation you will require RBI approval, but if you make the donation within the limit, then no RBI approval is required. Okay, now come to the second point. In the second point, guys, this is going to be very easy. The first point only is a little tricky. The remaining 3 points are very simple, guys. Easily you will understand. The second point I'm talking about commission. So straight away I will take you to the example which I have already made for you over here. Look at this one. Okay, see, let us say I have a house in Chennai. I want to sell away this house. Okay, I want to sell this house to a foreign buyer. So I go to a foreign agent. I go to an agent in the US and I tell this agent, get me a foreign buyer. So he finds me a buyer in the US. So to this agent I have to give him commission, guys. That commission, if I pay more than a certain limit, then I will require RBI approval. Understanding? Once again, who are you? You're a non-individual. What do you have in India? You have a residential flat in India, or you have a commercial plot in India. You want to sell this off, and you're selling it through whom? You're selling it through an agent abroad. So to this agent you have to pay commission, guys. So if you're going to make an outward remittance of foreign exchange because you want to pay commission to this agent for selling your property in India, then if you're making the payment of this commission more than a certain limit, you will require RBI approval. What is the limit over here? The limit is 5% of the inward remittance or $25,000, whichever is higher. So if you're paying commission more than this limit, you will require RBI approval. Once again, who are you? Non-individual. Now you have an immovable property where you have an immovable property in India, and you are selling it through whom? You're selling it through an agent abroad. Okay, now you have to pay commission to this agent. You have to make an outward remittance of foreign exchange to pay commission to this agent. If you pay commission within a certain limit, then RBI approval is not required. But if you pay commission to this agent abroad for selling your property in India more than a certain limit, then RBI approval is required. What is the limit over here? The limit is 5% of your inward remittance or $25,000, whichever is higher. See, from this foreign buyer, what is this inward remittance over here? I'll help you understand. From the foreign buyer, you're going to get money, right? You're going to have an inflow. The foreign buyer is going to give you dollars. You will get money inflow in dollars. So that is your inward remittance. So how much ever money you get from the foreign buyer, that money into 5% or $25,000, whichever is higher. That is the maximum commission you can pay without RBI approval. If you pay commission more than this limit, then you will require RBI approval. I want you to make one small observation over here. For this donation point, the limit was whichever is lesser. For the commission point, the limit is whichever is higher. Be careful. Okay. Then comes your third point. Again, third point for whom, guys? Who we are talking about non-individuals only over here. So in the third point, what happens is you are buying consultancy services from outside India. Like for example, let's say you're taking expert service from Deloitte US. You're taking expert service from KPMG US. You're taking consultancy services from outside India. Okay. Now for that consultancy services, you have to pay service charges. So if the consultancy service is relating to infrastructure project, like for example, let's say you want to construct one building in in India. You have a very fancy dream. You want to construct the world's tallest building in India. But in India, construction is not that advanced, not as advanced as construction is in Japan, in China, and all. So that is why what you do is you get some consultation from Japanese experts in construction. So you have to pay them now for the consultation charges. So if the consultation was relating to infrastructure projects, you can pay them maximum $10 million without any RBI approval. But if you're going to pay them more than $10 million per project, then you will require RBI approval. But if, however, you are making payment for consultancy services and you took consultation for any other purpose, not for infrastructure project, for any other project, if you took consultation service, and for that, if you are making the payment of service charges, if you will require RBI approval if you're making the payment more than $1 million per project. So be careful. Here, the limit is depending upon what is the consultation relating to. If it is relating to infrastructure project, your limit is $10 million per project. If it is any other consultation, your limit is $1 million per project. So if you're making a remittance of foreign exchange beyond this limit, then you will require RBI approval. Okay. So third is making payment of consultation charges more than the limit. Okay. Then comes the fourth point and the last point. Again, who are you? Non-individual. Straight away come to this example. You're a non-individual, you're a company, let us say. Now, when this company had to be incorporated, to incorporate the company, a lot of expenses have to be incurred, guys. Like, for example, you have to hire a lawyer to draft the MOA, to draft the AOA. Then in the whole incorporation process, you have to pay fees also to the ROC. So to incorporate the company, a lot of expenses were incurred. And who incurred all these expenses? Let us say some foreign company, B Inc., one American company. This company only had incurred all the expenses to incorporate a company in India. Now this Indian company is incorporated. Now this Indian company wants to return that money back. That Indian company wants to reimburse the pre-incorporation expenses which were incurred by the American company. Understanding? They want to reimburse the pre-incorporation expenses. They can do it, but if they are going to make an outward remittance of foreign exchange for this, if it is within a limit, they can do it without RBI approval. But if they are going to make a remittance of reimbursing the pre-incorporation expenses more than a limit, then RBI approval is required. What will the limit be over here? The limit will be 5% of the investment brought into India or $100,000, whichever is higher. See, take another example, okay? That is how you will understand this investment brought into India. Imagine this B Inc. is HP Inc. HP, Hewlett Packard, your laptops and computers, HP Inc., American company. Now, HP Inc. has a lot of employees in India. The whole revenue recognition team of HP Inc. is sitting in India only. So, it has hired all chartered accountants from India. They are only doing the whole revenue recognition work for this HP Inc. American company. Now, those employees are not employees of HP Inc. They are employees of HP India Private Limited. So, what has HP Inc. done? HP Inc. has created one subsidiary company in India. HP India Private Limited. Understanding? Now, to incorporate this private company, HP Inc. only will be incurring all the expenses. Now, once this company is incorporated, where will the capital in this company come from? The capital in the company will be invested by HP Inc. only. So, good for the country. Definitely good for the country, because HP Inc. is investing in its Indian subsidiary. HP Inc. is sending dollars to India, investing in this Indian company. So now HP India Private Limited wants to reimburse the pre-incorporation expenses incurred by HP Inc. It can reimburse. It can reimburse in foreign currency also. But how much maximum can you send without RBI approval? 5% of the investment brought into India. Now, are you understanding investment brought into India? Yes, guys. HP Inc., when they are setting up a subsidiary in India, they will be investing in this company, right? That's how this company will become the subsidiary of HP Inc. Subsidiary means what? More than 50% of its shares are held by HP Inc. So, if HP India Private Limited is giving shares to HP Inc., in return HP Inc. will give money, right? So, money is flowing into the country from HP Inc. So, investment is being brought into India by HP Inc. So, 5% of that money which is coming into India, 5% of the foreign capital which is coming into India, or $100,000, whichever is higher, that's going to be your limit. If the Indian company is remitting or reimbursing the pre-incorporation expenses more than this limit, only then RBI approval will be required. Understanding? So these are our 4 points under non-individuals. Don't forget, right now we're talking about current account transactions. In case you are doing current account transactions which are mentioned in schedule 3, for those you require RBI approval. In schedule 3 we had 2 parts. In the first part we spoke about individuals. This you are very thorough about. Now come to the second part. Once again, the second part is for non-individuals. In the non-individuals you have totally 4 transactions. In the first transaction, who are you? Non-individual. You are making an outward remittance of foreign currency. Why? Because you want to make a donation. How much donation you want to make? More than a limit. What is the limit? The limit is 1% of your foreign exchange earnings of the last 3 years or $5 million, whichever is lesser. So if you make a donation in foreign currency more than this limit, you will require RBI approval. And by the way, why are you making this donation? You're making this donation either because you want to create a chair in a foreign university, or you want to donate to a fund which is promoted by an educational institution, or you want to make a donation to a technical institution which is doing research in the same field as the company. Okay, that was your first point. In the second point, who are you? Again, non-individual. What do you own in India? You own in India some immovable property, and that immovable property you have sold to whom? To a foreign buyer. Through whom? Through a foreign agent. So you have to pay commission to the foreign agent for selling immovable property in India. How much commission are you paying? More than a limit. Only then RBI approval is required. What is the limit over here? The limit is 5% of the inward remittance or $25,000, whichever is higher. See, only for donation only it is whichever is lesser. For everything else it is whichever is higher. Okay. Then comes the third transaction. In the third transaction, you are taking consultation services from outside India. So you have to pay consultation charges. If you pay within the limit, RBI approval is not required. If you pay the consultation charges more than the limit, only then RBI approval is required. What is the limit over here? It depends upon you're taking consultation for what project. If you're taking consultation for infrastructure project, then the limit is going to be $10 million. If you're taking the consultation for any other project, the limit is going to be $1 million. Okay. And lastly, you're an Indian company. You are making a reimbursement of pre-incorporation expenses incurred by a foreign company. So for this, if you are making the reimbursement within a certain limit, then no RBI approval is required. But if you are making reimbursement beyond a limit, then RBI approval is required. What is the limit over here? 5% of the investment brought into India or $100,000, whichever is higher. Simple to remember. See, I'll tell you one small way in which you can remember it easily. Here also you have 5% of inward remittance. Here also you have 5% of investment brought into India, which is nothing but inward remittance. So we see, donation point is unique altogether. This separately we will learn, guys. Whichever is lesser makes it a unique point altogether. But however, this commission point and this pre-incorporation point, you can make it a little easier for yourself by remembering like this, that the first point is the same for both, 5% of inward remittance. Second number is $25,000 over here. Here it is $100,000. Okay, and this is anyway simple, guys. Consultation project, $10 million and $1 million. $10 million for infrastructure project and $1 million for other projects. Okay, so this was our entire discussion with respect to all the 3 schedules, guys. So if I come back to my foreign exchange management current account transaction rules 2000, which are given by the central government in consultation with RBI, we're done with schedule 1, the prohibited transactions. We're done with schedule 2, the transactions which are permitted, but permitted with central government approval. And now we've completed schedule 3, which contains transactions which are again permitted, but permitted with RBI approval. Here we learned 2 parts, part 1 and part 2. Part 1 relating to part 1 relating to individuals, and part 2 relating to non-individuals. Okay, now come on everybody, let's go on. We have just one last part of the current account transactions discussion. Let's discuss this carefully. Very, very simple discussions. We're done with the difficult part of the chapter, guys. Come on, listen to me. In case you are a person who is on a visit abroad, you're traveling outside India, you're on a visit abroad, and you're incurring money on any transaction which is mentioned in schedule 3. What is schedule 3, guys? Current account transaction requiring RBI approval. So you are abroad, you are spending money on some schedule 3 transaction through international credit card. Okay, and the amount of the expense is within the card limit. It is within the card limit. Then for that transaction, you don't require RBI approval. Simple point, guys. I'll explain it to you once again over here. Who are you? You are on a visit abroad, okay? And you're spending money. You're spending foreign exchange for what? You're spending foreign exchange for some schedule 3 transaction, okay? And you're using, how are you making the payment? You're making the payment through an international credit card. And how much is the payment, guys? The payment is within the card limit. So if these 4 conditions are fulfilled for that transaction, you don't require RBI approval. Generally, schedule 3 transaction, you will require RBI approval, no? But if you are making the payment through international credit card, and if it is within the card limit, then you don't require RBI approval. Okay, guys. Now come to the next point. In the next point, you are making a remittance from RFC account. RFC stands for Resident foreign currency account, resident foreign currency account. See, if you're making an outward remittance of foreign exchange from an RFC account, the remittance can be relating to schedule 2 transaction or schedule 3 transaction. Generally for schedule 2 current account transaction you require central government approval. Generally for schedule 3 current account transaction you require RBI approval. But if you're making an outward remittance of foreign exchange, which means if you're sending foreign exchange from India for schedule 2 or schedule 3 purpose, but if you're sending the money out of your resident foreign currency account, then in that case no approval is required. Even though schedule 2 transaction central government approval is not required, even though schedule 3 transaction central government approval is not required. But if I stop over here, you will never remember this. So that is why listen to my one small example, guys. You will never forget this after that. Imagine there is one person, Mr. Sharma, let us call him. This person, Mr. Sharma, he was earlier a non-resident, guys. Earlier he was PROI. He was working in US and he has earned a lot of wealth over there, lot of money he has. But now Mr. Sharma has come to India. So because he has come to India, let's say permanently. So therefore uncertainty element. So therefore he becomes a resident, guys. Remember residential status. If any person comes to India in the current year for either employment or for business purpose or any other purpose indicating uncertain element, then he will become a resident. So now Mr. Sharma has become a resident. But when he has come to India, now he brought with him all the money, all the wealth which he earned in US, everything he brought over here. So which means he brought the money in dollars, guys. So what he will do is, now today he's become a resident, he will go into a bank account and he will open a resident foreign currency account. In this resident foreign currency account in the bank, all the dollar money which he has brought in, no, he will put all that money over here. So that money, has he converted into INR? No, that money is still in dollars. He brought the money, he brought a lot of dollars into India, and as it is, he has put these dollars in resident foreign currency account. Now he is sending money from here. He is making remittances from this account. He is making remittances from this account for schedule 2 or schedule 3 transaction. Nobody's approval will be required. Logical, no. He brought the money from America and the money is still in dollars only. That same dollars only he is sending back outside India. Do whatever you want to do with this money, no limit, no approval will be required. Understanding? Resident foreign currency account means earlier you were a non-resident, earlier you were working outside India, you earned a lot of wealth, now you've come to India, now you've become a resident. So as a resident, you will open a foreign currency account in a bank. That account will be called as resident foreign currency account. Whatever wealth you brought from outside India, whatever dollars you brought, as it is those dollars you will deposit into this account. You will not convert into INR. Dollars itself you will deposit into this account. Now from this account, if you make an outward remittance for any schedule 2 or schedule 3 transaction, you will not require any RBI approval, you will not require any central government approval, also you will not require. Okay, same way, guys, same way, if you make any remittance from an EEFC account. What is EEFC account? This stands for Exchange Earners foreign currency account. Now this is generally for exporters, guys. So let's say you are an exporter, you exported a lot of goods to other countries. Now you have received foreign currency from the foreign buyers, guys. Obvious, right? You sold goods to foreign buyers, you exported goods from India to other countries. So from the foreign buyers, you are now receiving the money in foreign currency. So you went to a bank, you did not convert that money into Indian rupee, guys. That money is still in dollars only. You opened one exchange earners foreign currency account, and in this account you put that dollars as it is. You did not even convert it into INR. Whatever export you made, whatever the foreign buyers have paid you, as it is you have gone and deposited the dollars itself into this account. It's a bank account again. Okay, now from this account, if you are going to make payments, if you're going to make remittances, then no RBI approval will be required. But however, in 3 situations, you will still require approval. If you're going to make payment for a membership of P&I club, even if you're making the payment out of this exchange earners foreign currency account, you will require RBI approval. If you're making the payment of commission, remember you're making the payment of commission to an agent abroad for selling a removable property in India, more than a certain limit. The limit was 5% of your inward remittance or $25,000, whichever is higher. So if you're making payment of this commission more than the limit, then RBI approval will be required even if you make the remittance out of EEFC account. And lastly, if you're making that pre-incorporation expenses point, if you're an Indian company and if you're reimbursing the pre-incorporation expenses more than the limit, what is the limit over here? Same 5% of inward remittance or $100,000, whichever is higher. So if you make the remittance more than this limit, then you require RBI approval. Even if you're making the remittance out of EEFC account, you will still require this RBI approval. Okay, so in simple words, guys, even though you're making an outward remittance of foreign exchange, even though it is for schedule 2 or schedule 3 transaction, you still don't need any approval if the remittance is out of either resident foreign currency account or the remittance is out of exchange earners foreign currency account. But if the remittance is out of exchange earners foreign currency account and if it is for the purpose of payment of membership of P&I club, your protection and indemnity club, or commission to the foreign agent, or reimbursement of pre-incorporation expenses, then even though you are making the payment out of EFC account, you still require the required approvals. Crystal clear, guys? Resident foreign currency account and exchange earner foreign currency account. But tell me, using money from these accounts, can you do Schedule 1 transactions? No, that is still going to be prohibited. Schedule 1 transactions will still be prohibited. Schedule 2, Schedule 3 transactions only you can do by taking money from these two accounts. We will not require any approvals. But remember, exchange earner foreign currency account, if you use money from here for these three purposes, you will still require approval. Okay, guys. So this was our entire discussion with respect to current account transaction, guys. We learned the definition of current account transaction first. Then we had seen all our three schedules. Schedule 1 contains those transactions which are prohibited transactions. Schedule 2 transactions and Schedule 3 transactions both are permitted. But for these you require approval. Schedule 2 you require central government approval. Schedule 3 you require RBI approval. Okay, guys. And then we also learned if you make payment outside India through international credit card, if it is within the card limit, Schedule 3 transaction, you don't require RBI approval. And then we learned if you're making payment out of resident foreign currency account or out of exchange earners foreign currency account, even if it is Schedule 2 or Schedule 3 transaction, you don't require any approval. But if you're making the payment out of exchange earners foreign currency account, for any of these three purposes, you will still require the required approval. Okay, that's it, guys. With this we can close our current account transactions discussion and let us go into our capital account transaction discussion. As soon as we enter into capital account transaction, guys, we can say that we are almost near the end. If you have nicely understood till here, you can give yourself a nice pat on your back, appreciating your focus and your ability to concentrate. Now motivate yourself thinking that only two concepts are left: capital account transactions and liberalized remittance scheme. Only two concepts are left, and with that we get done. A chapter which is generally considered to be a dreadful chapter at the intermediate level, guys. I think very effortlessly we've been able to handle this, right? So come on, with a lot of energy, with a lot of motivation, let's enter into our discussion on capital account transactions. Now, capital account transactions, what do we already know about it? Let's talk about that. We know that capital account transactions generally impact your balance sheet. Point number 1. Then point number 2, we know that capital account transactions generally capital account transactions are prohibited, right, guys? Only when capital account transactions are permitted, it will be mentioned in the act. So generally it is prohibited unless specifically permitted. This is how we had learnt about it. Yes, guys. So these are transactions which generally impact your balance sheet, your assets and your liabilities, and generally they are prohibited unless they are specifically permitted. Okay, now come to this table straight away. You will understand the definition of capital account transactions over here. Capital account transaction means, so it starts with the word means. It's an exhaustive definition. It means a transaction which alters, it changes what? If you are a PRI, it changes your assets, liabilities, contingent liabilities outside India. But if you are PROI, it changes your assets, liabilities in India. That's all, guys. Simple definition. Easiest of all the definitions this is. So capital account transaction means a transaction which alters. It alters what? If I'm PRI, it will alter my assets and liabilities outside India. If I'm PROI, it will alter my assets and liabilities in India. Understanding? Once again. So what is a capital account transaction? It means a transaction which alters. It alters what? If I'm a PRI, it will alter my assets and liabilities outside India. If I am a PROI, it will alter my assets and liabilities in India. So it's ulta pulta. Okay. Now see, before we go any forward, I have left 4 examples over here. I'm going to ask you 4 questions, okay? You're going to try to tell me whether it is a current account transaction or a capital account transaction. How will you identify, guys? See, how will you know it is a capital account transaction? You will know it's a capital account transaction if it is going to alter asset or liability outside India of PRI or alter assets and liabilities in India of PROI. Right, guys? So capital account transaction means a transaction which will alter assets and liabilities outside India if I'm PRI, or if I'm PROI, it will alter my assets and liabilities in India. This is a capital account transaction. And current account transaction means what? Any transaction which is not a capital account transaction will become a current account transaction. Okay, so keep this in mind and look at my 4 examples, 4 questions. In my first question over here, PRI. imports machinery from a vendor in UK for installing in his factory. And let's say this is not a credit transaction. Let's say this transaction is for cash, which means immediately payment has been made in cash. It's a cash transaction. Okay. So PRI, think from the PRI's point of view. What is he doing, guys? He is importing machinery, which means he's bringing machinery into India, and in return he's making the payment to the UK vendor. From the PRI's point of view, is any asset getting created outside India? No, the machinery is being brought into India. Asset is getting created in India. For the PRI, is any liability getting created outside India? No liability, guys, because immediately payment is being made. So there's no liability also. So for the PRI, if you see, it is not a capital account transaction. Okay. Now think from the vendor's point of view. Let's say the vendor is PROI, guys, because UK vendor. So for the vendor also, no asset or liability is getting created or altered in India. So therefore, it is not a capital account transaction for any of them. So if it's not a capital account transaction, what will it become? It will become a current account transaction. Understanding, this transaction did not alter the assets and liabilities outside India of PRI. It did not alter the assets and liabilities in India of PROI. So it's not a capital account transaction. So if it is not a capital account transaction, it will become a current account transaction. I will first check is it a capital account transaction or not. Then only I will come to current account transaction. Okay. Now come to the second example over here. I'm a PRI. I imported machinery from a vendor in UK for installing in his factory on a credit period of 3 months. So I imported a machinery from UK vendor, but 3 months credit period, guys. So tell me from the PRI's point of view, is he creating an asset outside India? No, guys. He has bought a machinery. The machinery has come to India. He is importing the machinery. So he is not creating an asset outside India. Asset is getting created in India only. Tell me for this PRI, is a liability getting created outside India? Yes, a liability is getting created. No, he has to make a payment to this vendor. He made the PRI made the purchase on credit. 3 months credit period. So he has a payable. The PRI has a payable. The PRI has a liability outside India. But see, guys, only 3 months liability. And if you remember the current account transaction discussion, short-term banking and credit facilities will come under current account transaction, guys. So yes, there is a liability outside India, but it is a short-term liability, only 3 months. Generally, up to 6 months is considered as a short-term liability. Okay. So yes, a liability is getting created outside India, but it is a short-term liability. And because it's a short-term liability, we will consider it as current account transaction only. First, I did think about capital account transaction because a liability is getting created outside India. But then I saw, okay, it's only a short-term liability. So because it's a short-term liability, it will not go to capital account transaction. It will come to current account transaction only. Alright, guys. So what were the learnings from the first 2 points? In the first point, if you see, I made a purchase from a foreign vendor. I immediately made payment to him. So neither is any asset getting created outside India, nor is any liability getting created outside India. So therefore not a capital account transaction. If not a capital account transaction, it will become a current account transaction. Story over. In my second point, what happened? Yes, a liability did get created outside India. I have a payable. I have to make the payment within 3 months. I have a payable. Yes, a liability is getting created for me outside India. But however, it's a short-term liability. And short-term liability will not go to capital account transaction. It will go to current account transaction. So these were my learnings from the first 2 points. Now come on, I have 2 more points. Look at this one now. PRI transfers $1,000 to NRI brother in New York as a gift. PRI transfers $1,000 to his NRI brother in New York as a gift. Tell me, from PRI's point of view, PRI has transferred the money to his brother, guys. He has transferred the money already to his brother in New York. So for the PRI, is any asset created outside India? No. Is any liability created outside India? No. So therefore, this is not going to be a capital account transaction, guys, because no asset or liability is getting created. Even for the PROI, even for the brother, if you see, let's consider him as a PROI. Even for him, no asset is created in India, no liability is getting altered in India. So therefore, for the brother also, there is no asset or liability being created or altered in India. So it is not a capital account transaction. If it is not a capital account transaction, what will it become, guys? It will become a current account transaction. Simple. Now come to the last example over here. PRI gives PROI a gift in India in Indian currency. The gift is in India. So PRI gives PROI a gift in India in Indian currency. So for the PROI, where is the gift, guys? The gift is in India. Like for example, let's say PRI is giving PROI a house in India as a gift. So for the PROI, there's an asset now in India. Now the PROI has a house in India. So therefore for the PROI, an asset is getting created or altered in India, guys. So that is why for the PROI, this will become a capital account transaction. Understanding. So a capital account transaction means a transaction which alters either for PRI an asset or liability outside India, or it alters for PROI an asset or liability in India. So for any of them, if it does this alteration, it will become a capital account transaction. Here if you see, for PRI, it's not altering asset or liability outside India, this transaction. But for PROI, it is creating an asset in India. So therefore, this will become a capital account transaction. So either the capital account transaction should alter asset or liability outside India for PRI, or it should alter assets and liabilities in India for PROI. Then it will become a capital account transaction. And if it is a capital account transaction, it can't be a current account transaction. See, capital account transactions and current account transactions are mutually exclusive, which means, is it ever possible that the same transaction is both capital and current? Not possible. Impossible, guys. So if it, see, listen carefully. In my last example, for PRI, assets and liabilities outside India were not getting altered. But for PROI, assets and liabilities in India were getting altered, guys. My PROI now suddenly has a house in India. So if out of the two, any one bucket also fulfilled, it will become a capital account transaction. If it becomes a capital account transaction, it can't be a current account transaction. The same transaction can't be both capital and current. It is mutually exclusive. How come? Because we check first capital account transaction. If it is a capital account transaction, it is not a current account transaction. If it is not a capital account transaction, then only it becomes a current account transaction. So it is impossible for the same transaction to be both. Okay guys, still here clear? So as of now, guys, under capital account transactions, what have we learned? The most important point that we have learned is the definition as of now. What is the definition? Capital account transaction means a transaction which alters. It alters what? If you are a PRI, it will alter your assets, your liabilities, or your contingent liabilities where? Outside India. If you are a PROI, it will alter your assets or liabilities, not contingent liabilities, guys. It will alter your assets or liabilities in India. Understanding? So this is your broad definition of capital account transaction. It means a transaction which alters assets, liabilities, or contingent liabilities outside India of PRI, or it alters assets and liabilities, only two things, in India of PROI. Okay, now come on, let's go a little deeper inside this entire capital account transactions discussion. See, listen. A very important point now, okay. Now, in case any rules and regulations are to be made with respect to debt instruments, the power has been given to RBI. So, which transactions you can do with respect to debt instruments, what will be the limit, what are the conditions, all the discussions, all the regulations with respect to debt instruments, the responsibility has been given to RBI. RBI will make rules and regulations. But all the rules and regulations relating to non-debt instruments means what, guys? Equity. So in equity, like what are the capital account transactions which you can do with respect to equity? What will be the limit? What will be the conditions? All those rules and regulations will be made by the central government. Understanding, everybody? So rules and regulations with respect to capital account transactions, debt instruments, they'll be made by RBI, and capital account transactions relating to equity, those rules and regulations will be made by central government. Like for example, we have foreign direct investment, guys, FDI. What is FDI? FDI is nothing but a non-resident investing into India. If a non-resident is making an investment in India, let's say it's an equity investment. If it is an equity investment, the rules and regulations will be made by the central government. But however, if that same non-resident is buying, let's say, the Indian company's bonds or debentures, debt instruments means what, guys? Bonds, debentures, zero coupon bonds, all that will come under debt instruments. So for debt instruments, all the rules and regulations will be made by RBI. Remember this extremely important point, guys. This can be a good MCQ question. Okay, so this was another small point. Now listen, we have two extremely important points, one for PRI and one for PROI. If you understand PRI, same thing ulta will be PROI. The provision goes like this. Let's say you are a PRI. Okay, today you are a PRI. Okay, but however, you have some foreign currency, or you have some foreign security, or you have some immovable property. Today, what are you? Today, you are a PRI. But what do you have today? You have foreign currency, you have foreign security, you have immovable property outside India. How? How did you get all this? You are a PRI, no? Then how did you get foreign exchange? How did you get foreign security? How did you get immovable property outside India? Actually, what happened is earlier you were PROI. That time, you had acquired this foreign currency, foreign security, or immovable property. or you were never a PROI, but you inherited all this. You inherited all this from PROI. Understanding my situation? Today, what are you? PRI. Today, what are you having? Three things you're having: foreign currency, foreign security, immovable property outside India. How come? Did you buy today? No. There are two options. Either earlier you were PROI, that time itself you had all this, and today you've become PRI, you're continuing to have all this. Or second possibility is you were never a PROI, you're a PRI, but however you inherited this from a PROI. So in such cases, you are allowed to do whatever you want to do with these three things. You can continue to hold them, you can continue to own them, you can continue to transfer them, you can continue to invest them, you can do whatever you want to do with them. In fact, you can freely utilize all this without getting any RBI approval. Like for example, let's say you have shares of Apple. You can sell off those shares, get the money. With that money, buy some house in US. You can do whatever you want with this without any RBI approval. You can freely utilize all this. Understanding, guys? Now exactly the same thing ulta is there for PROI also. So same thing, exactly the opposite. You are a PROI, but what do you have? You have some Indian currency, you have some Indian security, or you have some immovable property in India. How come? You are PROI, no? So how do you have Indian currency in your hands? How do you have Indian security in your hands? How do you have immovable property in your hands? You bought. No, you didn't buy. Then what happened? Earlier you were a PRI. When you were a PRI earlier, that time you had purchased these Indian securities, immovable property. That time you had this Indian currency. You can continue to hold it. Or you were never a PRI. Today you are a PROI and you were always a PROI, but you inherited all this from another PRI. Exact same thing ulta, guys. You can continue to hold, own, transfer, invest, do whatever you want to do with this with these assets. No RBI approval is required. Understanding? Once again, we'll see it. First part. In the first part, who are you? In the first part, you are a PRI. And what are you having? You are having some foreign securities, or you are having some foreign currency, or you are having some foreign securities, or you are having some immovable property outside India. Okay, how come? Either there are two options. Either you were a PROI earlier, and that time when you were a PROI, that time you had purchased these securities, these immovable properties, or that time you had the currency. Or second option is you are a PRI and you were a PRI even in the past, but you inherited all of this from a PROI. So when this situation exists, then these foreign currencies, these foreign securities, these immovable properties that you own, you can continue to hold them, you can continue to own them, you can transfer them, you can invest them, you can do whatever you want to do with this you can continue to do whatever you want to do with these foreign currencies, foreign securities, and immovable properties outside India. No RBI approval is required. You are free to utilize. Same thing, exactly the opposite. In the opposite situation, what happens is, in the opposite situation, you are a PROI, okay, and you are having Indian currency, you are having Indian security, or you're having immovable property in India. But how did you buy? No, you did not buy. Either when you were a PRI earlier, that time you had bought these Indian securities, these immovable properties, you can continue to keep them. Or second option is you are a PROI and you were always a PROI. You just inherited all this from a PRI. So in such cases, same thing. You can continue to hold this amount. You can continue to own the securities. You can also transfer this immovable property in India. You can invest like for example, you can transfer the immovable property in India, get money, invest that money in Indian shares. You can do whatever you want to do with these assets. You can freely utilize. No approvals are required. Understanding, guys? So this is it about our entire discussion with respect to these two special points, one about PRI and the other about PROI. Now see, okay, I'm continuing the discussion which I had about PRI with you. For PRI, I had told you that today you're a PRI, but you're having foreign currency, you're having foreign security, you're having immovable property outside India. How come? Either you had acquired them earlier when you were a PROI, or you inherited them from a PROI, right, guys? So I'm continuing that over here. We have 5 points. Most of them are repetitive, easily you will understand, but extremely important, guys. So today you're a PRI, okay? But earlier you were a PROI. That time you had some foreign currency account, in that you have money. You can continue to hold that money, you can utilize that money, do whatever, no approval required. Today you are PRI, but earlier you were a PROI. That time you were doing some employment, business, vocation outside India. So that time whatever income you earned, with that income you can do whatever, you can freely utilize, no RBI approval is required. Then, today you are PRI, but earlier you were PROI. That time you had made some investment outside India. You can continue to hold that investment, own that investment, transfer that investment. Once you transfer the investment, whatever money you get, you can do whatever you want to do with that money. no restrictions, no approvals, no need of any RBI approval, freely you can utilize. Then today you are a PRI, but earlier when you were a PROI, that time you got some gift or that time you inherited something, you can continue to hold, own, transfer, invest. Similarly, today you are PRI, but earlier you inherited something from a PROI. You inherited some money, some foreign security or some immovable property outside India from a PROI. You can continue to hold it, you can continue to own it, transfer it, invest it, do whatever. Okay, these are just some extra examples. So whenever you get a question regarding this PRI point, you should also be writing these 5 points which I just discussed with you over here. That for basically all this is from an RBI circular, that they're just giving us a little more clarity. When you were a PROI, today you are a PRI, but when you were a PROI earlier, that time whatever foreign currency account you have, that time whatever income you earned from employment, business, vocation outside India, that time whatever investments you made, that time whatever gifts or inheritance you received, you can continue to hold, own, transfer, invest. Will you remember to write all the 4 keywords in your answer paper, guys? Hold, own, transfer, invest. Okay, so this was it about our discussion with respect to the preliminary part of capital account transactions. So before we go into the schedules, before we go into the different categories of capital account transactions, can we first revise everything that we have learned till here about capital account transactions, guys? Come on, let's do that. Till here whatever we've learned, let's do one quick revision. So the first thing I told you was over here that capital account transaction means a transaction which alters assets and liabilities and contingent liabilities outside India of PRI, or it alters assets and liabilities in India of PROI. Okay, then we learned first you will check capital account transaction. Only if it is not a capital account transaction, only then you will call it as a current account transaction. Okay, then we had learned all the rules and regulations relating to debt instruments are made by whom? RBI. But all the rules and regulations relating to equity instruments are made by central government. Then we had the PRI and PROI point. So what did we learn over there? We said that today you are PRI, but however you are having in your hands some foreign currency, or you're having in your hands some foreign security, or you're holding some immovable property outside India. How come? Did you buy today? No. There are only 2 options over here. Option number 1 was that you had acquired them earlier when you were a PROI. That time you had acquired them. Okay. Or second option is that you inherited these from whom? You inherited these from PROI. So if this is the case, then this foreign currency, foreign security, immovable property, you can continue to hold, own, transfer, invest. For this, any RBI approval is not required. You can freely utilize all this. Okay, then relating to PRI only, RBI circular, guys, 5 special points we had over there. If earlier when you were a PROI, that time you had some foreign currency account. In that foreign currency account, whatever money is there, you can continue to do HOTI. When you were a PROI, that time when you were doing some income, that time when you were doing some employment or some business or some vocation outside India, you earned some income. That income you can continue to HOTI. Then when you were a PROI earlier, that time you had some, you received some gift or you received some inheritance. So whatever asset you got by gift or inheritance, you can continue to HOTI. HOTI is hold, own, transfer, invest. Then earlier when you were a PROI, that time you made some investment. You can continue to HOTI the investment. And lastly, if you inherited any of these from a PROI, then you can then you can continue to HOTI. Okay, so this concept was with respect to PRI. Then same thing as it is we spoke about for PROI also. So today you are a PROI, but you are still having some Indian currency, or you're still having some Indian security, or you're still having some immovable property in India. How come? Did you buy? No. Earlier you were a PRI. That time you had purchased all this, or earlier you had inherited all of these from a PRI. So these Indian currencies, Indian securities and immovable properties in India, you can continue to HOTI, hold, own, transfer, invest. Okay, so this is all the learning that we have done until now, right guys? Now let's go on to the core discussion of capital account transaction, the main part of a capital account transactions. We are going to divide capital account transactions into 3 categories. Do you remember when it came to current account transactions, even that we divided into 3 categories, guys? We had schedule 1, which was prohibited transaction, schedule Schedule 2 and Schedule 3 were both permissible transactions, but Schedule 2 required central government approval, Schedule 3 required RBI approval. So we had 3 schedules, 3 categories of current account transactions. Now coming to capital account transactions, guys, here also we have 3 buckets, okay? Like how current account transactions we had 3 buckets, here also we have 3 buckets, but they are 3 totally different buckets. So don't try to make any interconnections, don't try to learn one dependent on the other. Instead, look at them as 2 independent concepts altogether. When it comes to capital account transactions, I have 3 buckets even over here. In my first bucket, guys, I am having transactions which are permissible transactions. Permissible transactions. So we have Schedule 1, which talks about transactions which are permitted for PRI, and Schedule 2 transactions which talk about transactions which are permissible for PROI. Okay. Then in the second bucket, we have those transactions on which neither RBI nor central government, nobody can put any restrictions. So freely we will let people do these transactions. We have only 2 transactions in the second bucket. These 2 transactions anybody can do, nobody's approval is required, nobody can put any restrictions on the transactions in the second bucket. Then we have third bucket, guys, prohibited transactions. Even in prohibited transactions, we will be learning in 2 parts. First, what is prohibited for PRI, and then what is prohibited for PROI. Okay, so capital account transactions we will be learning in 3 buckets. First bucket, permissible transactions. Second bucket, those transactions on which nobody, neither RBI nor central government, nobody can put any restrictions on some transactions, that we will be learning in our second bucket. And in the third bucket, we will be learning prohibited transactions. Okay, now come on, let us talk about the first bucket. Let us talk about the permissible transactions. What are the permissible capital account transactions? Now these permissible transactions, we have Schedule 1 and Schedule 2. I told you this Schedule 1, Schedule 2 is given where? This Schedule 1 and Schedule 2 is given in Foreign Exchange Management Permissible Capital Account Transactions Regulations 2000. Now see, there's an opportunity, there's a chance of making a silly mistake over here. See, when it comes to current account transactions, what was the name of that rules or regulations, whatever, which contained the 3 schedules? We called it as Foreign Exchange Management Current Account Transactions Rules, guys. These were rules 2000. Right? And who gave these rules? These rules were given by central government. That's how we learnt it. Now coming to capital account transactions. For capital account transactions, we have Foreign Exchange Management Permissible Capital Account Transactions Regulations 2000, which are given by not central government, RBI. Be very, very careful. For current account, I am calling it Foreign Exchange Management Current Account Transactions Rules 2000. For capital account, I am calling them Foreign Exchange Management Permissible Capital Account Transaction Regulations 2000. Current account, these rules are given by whom? Central government. Capital account, these regulations are given by whom? RBI. Be extremely careful, because in your examination you will have to write all this in your answer. You can't mix them up. Both are 2000, but for current account we have rules made by central government. For capital account we have regulations made by RBI. Okay guys, now come on. So inside these regulations, which regulations? Foreign Exchange Management Permissible Capital Account Transactions Regulations 2000. These regulations are made by whom? Made by RBI. We have 2 schedules. Schedule 1 tells us what are the permissible capital account transactions for PRI. Schedule 2 will tell us what are the permissible capital account transactions for PROI. Okay guys, come on, let's see them one by one. Let's see Schedule 1 first. What is permissible capital account transaction for PRI first? Number 1, a PRI can make an investment in foreign security. I am a PRI, I am a resident in India. I can buy Apple shares, I can buy Tesla shares, no problem. Then I can give foreign currency loans raised in India or abroad by PRI. I can borrow loans from outside India. These are called as external commercial borrowings. Basically, I am borrowing loans from outside India, permissible. Then I can transfer immovable property outside India. I have some house in US, I can transfer it. I can give guarantees in favor of PROI. Let's say a non-resident, let's say for example, let's say Mr. John, he lives in the US. Okay, he has borrowed a loan from some bank. Now I am a PRI. I can give guarantee to this bank that don't worry, Mr. John will repay the loan. If Mr. John doesn't repay the loan, I will repay the loan. Like that, I can give guarantee for a PROI. Okay, then I can freely export, import, I can hold currency notes, no problem. Then loans and overdraft by PRI from PROI, loans and overdraft by PRI to PROI, which means I can borrow a loan from PROI. I can also give a loan to PROI, no problem. Then maintenance of foreign currency accounts. I can maintain foreign currency accounts in India also, outside India also. I can take insurance policy from a foreign life insurance company also. Then I can remit outside India of capital assets of PRI, and I can also undertake derivative contracts, no problem. So these are all permissible transactions, permissible capital account transactions as per Schedule 1, as per Schedule 1 of Foreign Exchange Management, Permissible Capital Account Transactions Regulations 2000 made by RBI. They are applicable only for PRI. If you see, almost everything is covered over here, guys. PRI can invest in foreign securities. PRI can also borrow loans from foreign country. PRI can transfer immovable property outside India. PRI can give guarantee in favor of PROI. PRI can export, import, hold foreign currency. PRI can give a loan to PROI, also can take loan from PROI. I can also maintain foreign currency accounts. I can take insurance policy from a foreign country. I can also remit out of my capital assets. I can also undertake derivative contracts. I can do any of these if I'm a PRI. Now same thing ulta, guys, for PROI Schedule 2. What are the permissible capital account transactions for PROI? Exact ulta, guys. Just like how PRI can invest in foreign securities, same way PROI can invest in India. They can buy Indian securities. Then they can also acquire and transfer immovable property in India. See, be careful over here. There's a small difference. When it comes to PRI, they can transfer immovable property. They can't acquire. Acquire is not mentioned over here. But however, for PROI, I have mentioned acquisition and transfer of immovable property in India. Then even PROI can give guarantee in favor of a PRI. Even they can import, export, hold currency notes and all. They can also make either give loans to PRI, or they can borrow loans from PRI. They can also maintain foreign currency accounts. They can also make remittance out of capital assets. Even they can enter into derivative contracts. So more or less, it is exactly the same, guys, both the lists. Notice a big difference over here. The big difference is this point. When it comes to immovable property, PRI is permitted to transfer immovable property outside India. But when it comes to PROI is given the permission to acquire and transfer immovable property in India. Okay, so these are permissible transactions. Permissible for whom? Schedule 1 is permissible for PRI. Schedule 2 is permissible for PROI. These permissible transactions are permitted by whom? By RBI under the Permissible Capital Account Transactions Regulations 2000. Okay, now listen. So this was your first bucket. Your first bucket talks about the permissible transactions. Okay, now come to the second bucket, guys. Transactions on which restrictions cannot be imposed. Now this is the most important discussion in our entire capital account transactions discussion. The transactions on which restrictions cannot be imposed. Whether you are PRI, whether you are PROI, I don't care. Whether RBI, whether central government, I don't care. Nobody can put any restrictions on two capital account transactions. Number one, amortization of loan. What is amortization of loan? Very basic, guys. Imagine there's a foreign lender and I borrowed a loan from this foreign lender. He will give me loan in dollars, guys. Now I have to repay the loan. So if I borrowed the loan in dollars, I have to repay also in dollars. To repay the money in dollars, there will be outward remittance of foreign exchange. Will you ask me to go and get RBI approval? Will you ask me to go and get central government approval? No, nobody's approval is required because this is genuine repayment. I borrowed a loan, of course I have to make the repayment. So when I make the repayment, I can make the repayment freely in dollars. Nobody's approval I will require for this repayment transaction. Nobody can put any restriction on me. Okay, guys, first point. Then comes the second point. Depreciation of direct investment in ordinary course of business. I'll explain to you. Let us say I'm a PRI. Okay, and I have made an investment outside India. Let's say I purchased shares outside India. I made an investment outside India. Now I made an investment in some foreign company outside India. Now in that foreign company, lot of losses, guys. Let's say originally I had invested, 1 minute. Let's say originally I had invested $50,000 in this foreign company, guys, but lot of losses in this foreign company, and because of that, the value of my investment has depreciated. Even though I had originally invested $50,000, the value of my investment is now only $40,000. So the value of my investment has depreciated. But let us say because of the applicable rules and regulations or whatever, I am supposed to maintain this $50,000 investment. So that, but then, however, now the value of my investment has dropped to 40,000. So therefore, I have to send $10,000, guys. I have to make an outward remittance of $10,000. I have to send $10,000. So I'm making an outward remittance of foreign currency. But why? Only because of depreciation of my already existing investment. So even though there is going to be an outflow over here, even though there is going to be an outward remittance of foreign currency over here, still I do not require anybody's approval on this transaction. Also, nobody can put any restriction on me. So there are two transactions on which nobody, central government, RBI, nobody can put any restrictions. Number one, repayment of loans, which is called as amortization of loans, and number two, depreciation of direct investments, which means the value of my investment has decreased. So I'm sending more money now to ensure that the value of my investment remains intact. So I'm sending more money. I'm making an outward remittance of $10,000. Even for this transaction, nobody's approval is required. So guys, first we learned about the permissible transactions. As per Foreign Exchange Management, Permissible Capital Account Transactions Regulations 2000, Schedule 1 was which transactions are permitted for PRI, and Schedule 2 was which transactions are permitted for PROI. Then we learned about transactions on which nobody can impose any restrictions. Now come to the prohibited transactions, guys. There are some transactions which are prohibited. Now in these prohibitions, we will first learn from the PROI's point of view that which capital account transactions are prohibited for PROI, and then we will come to PRI. For PRI, only one prohibition is there. Let us talk about PROI first. There are some capital account transactions which a PROI is prohibited from entering into. Number one, a PROI cannot invest in a chit fund business. However, a PROI can give a subscription to a chit fund business with the permission of the registrar of chits or an officer authorized by state government. So once again, point number one, PROI cannot invest in chit fund business, but he can subscribe to a chit with the permission of registrar of chits or any other officer authorized by the state government. Point number one, first prohibition. Second prohibition, the PROI cannot invest in a nidhi company. Okay. Then point number three, PROI cannot invest in agricultural or plantation activities because, come on, obviously, India is primarily an agricultural country. So we can't give our entire economy itself to PROI, not right. Prohibition. Then comes the fourth prohibition. PROI cannot invest in real estate business, cannot construct farmhouses. So we don't want him to trade, buy, sell immovable properties. We don't want him to enter into real estate business. We don't want him to construct farmhouses. But however, he can develop townships. He can come and help us in constructing residential and commercial premises. He can come to India and help us in constructing roads and bridges. He can invest in real estate investment trusts, but he cannot invest in real estate projects. Basically, he can't do real estate trade, guys, and he also can't construct farmhouses. And then comes the fifth prohibition, the last prohibition. He cannot trade in transferable development rights. Now, what are these transferable development rights? What are these TDRs? Let me tell you, and then I'll give you a revision of the whole thing once again. See, very simple, okay. You know about compulsory acquisition of immovable property. In your income tax, you must have learned that many a times the government compulsorily acquires. Sometimes the compensation which the government gives for the compulsory acquisition is a little lesser than the market rate. So when it is lesser than the market rate, the government will also give something called as TDRs, transferable development rights. Just like how you have a stock market where you can buy and sell shares, similarly there is a TDR market also where you can buy and sell TDRs. Okay, and TDRs are generally purchased by those people who are into real estate, constructing buildings, developing properties and all of that. So if you're a PROI, you cannot trade in transferable development rights. You can't trade in TDRs. It is prohibited for you. So come on, guys, let's summarize now. I've made a list over here. Answer this. With this, your prohibitions will get sorted. Your person is a PROI, person resident outside India. So can he do these capital account transactions? Can he invest in chit funds? No. Can he subscribe to chit funds with the permission of registrar of chits? Yes, this he can do, guys. 1 second. So yes, he can subscribe to chit funds with the permission of registrar of chits. That is allowed. He can't invest in chit funds, but he can subscribe with the permission of registrar of chits. Can he invest in nidhi companies? No. Can he invest in agricultural activities, plantation activities? No. Can he do real estate business? No. Can he construct farmhouses? No. But can he develop townships? Yes, we will let him do development work. Construct roads and bridges? Yes, we will let him improve our infrastructure. Then construct residential premises? Yes. Construct commercial premises? Yes. Can he also invest in real estate investment trusts? Yes. But can he trade in TDRs? No. So whatever we have learnt in this page with respect to PROI, guys, I have just summarized it over here. So what are the things he cannot do? He cannot invest in chit funds. He cannot invest in nidhi companies. He cannot invest in agricultural activities and plantation activities. He cannot do real estate business. He also can't construct farmhouses or trade in TDRs. But what are the things he can do? Our whole focus is on PROI. Don't forget that, okay? What are the things he can do? He can subscribe to chit funds with the permission of registrar of chits. He can develop townships, construct roads and bridges, construct residential premises, commercial premises, and he can also invest in real estate investment trusts. Okay, so this was our whole discussion about PROI. Now come on, let's talk about PRI. A PRI has only one single prohibition, guys, and the prohibition is that he should not do any transaction with a citizen or a resident or an entity which is incorporated in North Korea. That's all. Only one simple restriction, that you should not do any transaction with any citizen, resident or entity of North Korea. Indians, PRIs are not allowed to do any transactions with North Korean people or North Korean entities. In fact, if you have a transaction, within 180 days, you must liquidate, dispose or settle the transaction from the date specified by central government. Understanding? Number one, you should not even do any transaction with people or entities of North Korea. In case you have done the transaction, then from the date specified by central government, from that date, within 180 days, you must liquidate the transaction, dispose the transaction or settle the transaction. Okay. So this is it about our entire discussion with respect to capital account, guys. So with respect to capital account transactions, we spoke about three buckets. In our first bucket, we saw the transactions which are permissible. So here we learned separately for PRI and separately for PROI. So the regulations that we learned, the Schedule 1 and the Schedule 2, those regulations are for these permissible transactions only. Then we learned two transactions on which no restrictions can be imposed. One was amortization of loan, nothing but repayment of loan, and the second was refilling the shortfall in the investment because of depreciation. Remember, there was depreciation in my investment, so I made an outward remittance to refill the shortfall. Even for that, no approvals are required, no restrictions can be imposed. And lastly, we learnt about the prohibited transactions. Here also we learnt in two parts, prohibited for PROI and prohibited for PRI. Okay, so this was our entire capital account discussion. Now come on, guys, let's go to our last concept in our FEMA discussion, which is going to be about liberalized remittance scheme. Now this liberalized remittance scheme, this concept which we very popularly call as LRS, this has an impact in current account also, it has an impact in capital account also. But I did not even talk to you about this neither in current account nor in capital account. Now we're going to discuss about it entirely, fully, extremely simple concept. You wait and watch, one explanation itself you will understand. Now this liberalized remittance scheme is a scheme which is applicable only to those individuals who are PRIs. First of all, it is not applicable to non-individuals, and secondly, it is not applicable to PROI. So it is applicable only to individuals who are PRI. Okay, so what we have discussed now is that LRS will apply to whom? It will apply to those individuals who are PRI, fine. Now comes the question, LRI will apply to which transactions? It will apply to only those transactions to which RBI approval is required. Okay, now these transactions can be current account transactions also, they can be capital account transactions also. But which current account transactions, which capital account transactions? For that, I have to give you a summary of the transactions first. Now current account transactions, if you see, number one, we have prohibited current account transactions, guys. Schedule 1, if you remember, remittance out of lottery winnings, then remittance out of race winnings, remittances to purchase lottery tickets, banned and prescribed magazines, sweepstakes, football pools, all that. So we have prohibited transactions, Schedule 1. Then we have permitted transactions, transactions which require central government approval. They are permitted with central government approval, Schedule 2 transactions. Here we had that foreign print media, remember? Then prize winnings for sports activities, transponders, all those points we had here. Then we have those transactions which are permitted with RBI approval. Schedule 3 transactions. So here we had private visits, emigration, medical expenses, all that we had here. So when it comes to current account transactions, first of all tell me, will LRS apply to current account transactions also? Yes, it will apply to current account also, capital account also, it will apply to both. But it will apply to only those transactions for which RBI approval is required, guys. So which means it can't apply to Schedule 1 because Schedule 1 is anyways prohibited. It can't apply to Schedule 2 because Schedule 2 requires central government approval. It can apply only to these Schedule 3 transactions. So therefore, LRS will apply to which current account transactions? Only to those current account transactions which are mentioned in Schedule 3. Till here sorted. Now come to capital account transactions. In capital account transactions, number 1, we have permitted transactions. Remember, we have Schedule 1 for PRI, Schedule 2 for PROI. So see, LRS we know can't apply for PROI because LRS is only for PRI, guys, only for those individuals who are PRI. So first of all, LRS can't apply to Schedule 2 transactions because Schedule 2 is for PROI. Then there are 2 transactions on which no restrictions can be imposed. One is amortization of loan and the other is depreciation of direct investment. So on these transactions, no restrictions can be imposed. So even RBI approval is not required. Nobody's approval is required. So even this can't come under LRS. Then prohibited transactions, they're anyways prohibited. Even they can't come under LRS. So LRS will apply to what now? What are we left with? We're only left with Schedule 1 transactions. So coming back to this now, LRS will apply to whom? To whom? It will apply to those individuals who are PRI. It will apply to which transactions? To those current account transactions which are mentioned in Schedule 3 and to those capital account transactions which are mentioned in Schedule 1. Understood? Why not Schedule 2 transactions? Schedule 2 transactions are also permissible, but Schedule 2 is only for PROI, but LRS is only for PRI, so only Schedule 1 transactions. Okay guys, so come on, coming back to my summary page now. I am trying to make a summary of LRS for you over here. So LRS is applicable to whom? It is applicable only to those individuals who are PRIs. Okay. Then my second question is applicable to which transactions? It is applicable to both, to current account transactions also, to capital account transactions also, but only to those transactions which require RBI approval. That is, in current account transactions, Schedule 3 transactions, in capital account transactions, Schedule 1 transactions. Okay, now listen to the main point or the main equation of LRS. LRS says, listen, whether you are doing current account transactions of Schedule 3 or whether you are doing capital account transactions of Schedule 1, everything put together, we will see how much is your total outward remittance of foreign exchange. Your current account Schedule 3 transactions plus capital account Schedule 1 transactions put together, how much is total outward remittance of Forex? If it is within $250,000, not rupees, within $250,000, then in that case, generally RBI approval is required. No, current account transactions Schedule 3 you require RBI approval, capital account transactions Schedule 1 you require RBI approval. Generally RBI approval is required, but if you're emitting within $250,000, then RBI approval is not required. So through LRS, indirectly, RBI is trying to make life easier for itself. RBI is saying if you're an individual and a PRI, and if your total current account transactions under Schedule 3 plus total capital account transactions under Schedule 1 put together, if your total outward remittance for both of these transactions put together is within $250,000, then RBI approval is not required. Only if it is more than $250,000, only then come to RBI for approval. Generally, if you see all current account Schedule 3 transactions, generally your Schedule 3 transactions you can do only with RBI approval. But if you're spending within $250,000 only, then in that case RBI approval also is not required. Freely you can do the transaction. You got the point, guys? So this is the main part of LRS. Now listen to the next point. In your current account transactions, let me take you back to Schedule 3 first. Here, this was your Schedule 3, guys. Your Schedule 3 of current account transactions, these are the transactions which are permissible with RBI approval. But now what is a new learning? That even though we learned it is permissible with RBI approval, but still if the outward remittance total put together is within $250,000 only, then RBI approval also is not required. Now in this discussion, in this list, if you remember, we highlighted emigration, medical treatment abroad and studies abroad. I told you for these 3 points, we have some special points which we will be seeing later. That special point is relating to LRS only. So the provision says that emigration, then medical treatment abroad, and studies abroad. For these three things, even if you are remitting more than $250,000, even if it is more than $250,000, okay. But however, like for example, when it comes to emigration, if you recall, I told you, like for example, let's say I want to go to Canada, I want to take up a job over there. Now, Canada government will tell me minimum how much money I have to bring with me, because that if I go to Canada empty-handed, then I will become a burden on the Canadian government. So if I'm emigrating, if I'm leaving my country, and if I'm going to go and settle down in Canada, and if the Canada government tells me, listen, bring $300,000, so yes, I'm doing an outward remittance of more than $250,000, but it is on the basis of an estimate given by Canada government, guys. So in this case, even if it is more than $250,000, still I don't require RBI approval. Understanding? So in these three situations, even if I am remitting more than $250,000, but if it is because of an estimate given by the foreign government, or if it is medical treatment, if it is because of an estimate given by the foreign hospital, or if it is for studies, if it is because of an estimate given by the foreign university, even if I'm remitting more than $250,000, still I don't require RBI approval. Understanding, guys? So can we come back? Can we summarize? That's all, guys. This is it about the LRS scheme. LRS is applicable to whom? It is applicable to individuals who are PRIs. And it is applicable to which transactions? To those transactions to which RBI approval is required. That is, in current account, Schedule 3 transactions, in capital account, Schedule 1 transactions. These current account plus capital account, everything put together, in a year, if the total outward remittance of all of these transactions put together is within $250,000, then no RBI approval is required. Is $250,000 per year limit? Yes, it's a per annum limit, guys. In a year, if your total outward remittance of current account, capital account, these Schedule 3, Schedule 1 transactions put together, if it is within $250,000, then no RBI approval is required. Then we learned three special points. Special point number 1, emigration. Special point number 2, education abroad. Special point number 3, medical expenses abroad. All of these are current account or capital account transactions, guys. All of these we learned in current account. In current account, we learned them in Schedule 3. All of these are current account Schedule 3 transactions. For these transactions, even if the remittance is more than $250,000, but however, if it is on the basis of the estimate given by the foreign country, foreign university, or foreign hospital, even if it is more than $250,000, but if it is on the basis of an estimate given by the foreign entity, then in that case, even though it is more than $250,000, still RBI approval will not be required. Okay, guys, that's all. This is it about LRS. LRS, which unnecessarily students keep getting worried about. This is all what LRS says. That current account Schedule 3 transactions plus capital account Schedule 1 transactions put together, if it is within $250,000, no RBI approval is required. Come to RBI only if you are remitting more than $250,000. Okay, now come to one last concept in our FEMA discussion. With this, we will be done with the chapter. One last concept, guys. This concept is applicable to a person who is a PRI, but he's not permanently resident in India. He's PRI, but he's not permanently resident. What does this mean? Imagine a person comes to India for the purpose of employment. As soon as he comes to India for the purpose of employment, three purposes, guys. He's coming to India for the purpose of employment or business or vocation or for uncertain period. Then you will immediately call him as PRI. So because he's come to India for employment, he's a PRI. But guys, he's not come to India forever. He has come to India only for maximum 3 years. He is coming to India with a target, I'm going to go back after 3 years. So in such case, because he came to India for the purpose of employment, yes, he is PRI. But because he knows when I'm going to go back, he is not permanently resident in India. So PRI but not permanently residents in India are those persons who've come to India for the purpose of employment, but the duration for which they've come to India is not for more than 3 years. In such cases, generally what happens is, that person, he alone will come to India because only for 3 years, no, he's anyways going to go back. So his family, his children and all will still be outside India only. So whatever he earns, he will want to send as it is outside India, fully he'll want to send outside India. So that is why the law says that, listen, if you're a PRI, but you are not permanently resident in India, we understand that you've come to India only for short term, you wouldn't have brought your family along with you. We know that your family would still be outside India, you will want to send money for their maintenance. So on you also Also, if we apply $250,000 limit, it will become unfair. So for such kind of people, what we will say is, whatever net salary they are earning in India, whatever be the amount, whatever is the net salary which they are earning in India, as it is fully they can send outside India without RBI approval, no problem. We will not put any restriction on you, because we understand that you've come to India only for 3 years. Okay, so we understand your family is still outside India only. We understand you will want to send as much money as possible for their maintenance. So whatever is your net salary, fully if you want, you can do an outward remittance. Nobody's approval we will ask you to get. No RBI approval, nothing is required. Now the only question is, what is net salary? Net salary means after deducting TDS, after deducting contribution to PF, basically the net salary in hand. How much salary you get in hand, that much fully as it is. If you want, you can remit without RBI approval, no restrictions, no questions asked. Alright guys, that is it. So this was our entire discussion of the concepts in your FEMA. Alright, in the first part of the session, we spoke about the preamble, the extent, the applicability, the commencement and all that. Then after that, we learned about the 4 small definitions, if you remember: authorized person, import, export and currency. Then we learned 2 important definitions: foreign exchange and foreign security. Then we had a very important discussion relating to residential status. Don't forget, when it comes to residential status, first you will check whether he has come to India. If yes, is it for 3 purposes. If he's not even come to India, then you will check, is he going out of India? If yes, is he going out for 3 purposes? But if he's neither coming to India nor is he going out of India, then you will straight away go to the 182 days criteria. Then after residential status, we had learned 2 small concepts, remember? No person shall deal in foreign exchange or foreign securities otherwise than through authorized persons. Your Havala transactions, all that we had learned. Then we had learned after that, no person shall acquire, hold, own, possess or transfer any foreign currency, foreign securities and all. Then we had learned about the meaning of transfer for the purpose of FEMA. Then we started learning about current account transactions, capital account transactions, and then we've learned now about LRS, Liberalized Remittance Scheme. LRS you've understood, right? Individuals and PRI, current account, capital account put together, if the total outward remittance of Schedule 3 plus Schedule 1 put together is within $250,000, then no RBI approval is required. Okay, so with this guys, I think we can confidently close our concept revision over here. In the next session, we will do the questions of FEMA one by one. I have a very good number of questions for you. We have a lot of case-based MCQs as well. We have a lot of descriptive questions as well. So indirectly, second revision you will get of the whole chapter once again through those questions, guys. We will end up spending one whole nice lengthy session on just questions. Okay, I'll close the concept revision over here very happily and with a lot of contentment that in a very effortless manner, I think we were able to finish off the FEMA discussion. Let's see how effective our discussion was. We will get to know when we do the questions. Alright, bye-bye. Before I close this chapter, guys, there's one provision, okay, section 6, which I have actually discussed with you as a part of our FEMA discussion itself, but I want to stress on it once again. So just for my satisfaction, that one concept, once again, I want to do for you, please listen. The provision goes like this. Let's say I am a PRI, okay, and I'm having some foreign currency in my hands, or let us say I am having some foreign security in my hands, or let's say I'm having some immovable property in my hands. Now all this is outside India, but how come guys, I'm a PRI? How do I have foreign currency in my hands? How do I have immovable property outside India? Did I buy it today? No, I had acquired these earlier when I was a PROI. I had acquired these, or I had inherited these from a PROI. Okay guys, so when this happens, now when I become a PRI, I am allowed to continue to hold, own, transfer or invest these assets. Okay, now listen, relating to this, RBI has given a circular. So as per this RBI circular, this provision will apply in certain transactions. Like for example, when you were a PROI earlier, that time you had some foreign currency bank account. Now in that bank account, you still have money. You can continue to maintain that bank account. Whatever money you have in that bank account, you can continue to hold it, you can continue to invest it. Even though you've become a PRI today, you can continue to maintain this bank account. Then number two, let us say earlier when you were a PROI, that time you were doing some employment outside India, okay, employment or business, whatever. From that you have income. You still have income. You still haven't finished utilizing that income. You're still having income which you had earned earlier when you were a PROI. So even this becomes an asset which you can continue to hold, own, transfer, invest. Then comes the third point. Let us say you have some investment which you had made outside India. Earlier, when you were a PROI, that time you had made this investment. Or let us say you have received some gift or you have received some inheritance when you were a PROI. Okay, so all of these become your eligible assets. Today, who are you? Today, your residential status is PRI. Today, you are a PRI. Now, all of these assets that you are having are relating to the time when earlier you were a PROI. So, these become eligible assets. Okay. Now, these eligible assets, also income from these assets, also sale proceeds from these assets, all of this you can freely utilize. Freely utilize means what? Freely utilize means you can make payments or investments where outside India. How? Out of these eligible assets, out of these eligible assets, and you can do this without any RBI approval. You just have to ensure that you comply with FEMA provisions. This is the entire concept, guys. Can I tell you once again? Listen to me. Today you are PRI, but however you are having foreign currency, foreign security, immovable property which is outside India. How come? Either you had acquired them earlier when you were a PROI, or you were never a PROI. You are a PRI and you were always a PRI, but you have inherited all this from a PROI. So in this case, these assets you can continue to hold, own, transfer, invest. This is what FEMA says. Now relating to this, RBI has given a detailed circular. RBI has said that this provision will apply in these transactions. RBI says that earlier when you were a PROI, that time let's say you had a foreign currency bank account. In that bank account you still have money. Now you can continue to maintain that bank account. You can continue to hold that bank account. You can continue to do transactions in that bank account. Then number two, let us say earlier when you were a PROI, you used to do a job, let's say. From that job you had earned a lot of money. You still have that money. That money you can continue to hold, own, transfer, invest. Then let's say earlier when you were a PROI, you had made some investment outside India. You can continue to hold, own, transfer that investment. Then let's say you had received some gift or you had received some inheritance earlier when you were a PROI. So all of these assets become your eligible assets. These eligible assets, incomes from these assets, like let's say you have an investment outside India. Let's say you had shares of a foreign company which you had purchased from when which you had purchased when you were a PROI. So from those assets, from those shares, you will be getting dividend income, guys. So all of these assets, incomes from these assets, sale proceeds from these assets, you can freely utilize, which means these assets, using money from these assets, you can make payments, you can make investments outside India out of these eligible assets without getting RBI approval, provided it is permitted under FEMA. Like for example, let's say you have money in your foreign bank account. Using this money in your foreign currency bank account, you can pay your premiums outside India. Generally, if you want to pay premium, if you want to pay life insurance premium outside India to a foreign life insurance company, it comes under capital account transaction, guys. Schedule 1, permissible capital account transaction, it comes under that. So generally you require approval, but no need. Without RBI approval, you can do all these transactions. Just that it should be as per FEMA. Just that you should not be using this money to make prohibited transaction and all. But if you are complying with FEMA provisions, then these eligible assets you can freely utilize. Okay, I know I've spoken to you a little bit about this when I was doing the revision, but I just wanted to discuss this with you once again, all over again in full detail, guys, because of late I have been noticing that the examiner has been testing this pretty often in MTPs also, in RTPs also, in examination questions also. So I did not want to take a risk over here. So that's why I'm hoping now you've understood these are called as your eligible assets, and you can freely utilize these assets. You can utilize the assets also, incomes from these assets also, sale proceeds from these assets also. Okay, that's it, guys. This is it with the extra point I wanted to discuss with you.